Are you recording this?
I'm very much familiar with the do-it-yourself investor. That was my job before I started Zega, right? Supporting the do-it-yourself investor, whether it was building the platforms, getting them access to products like, margin and options, futures, forex, everything there, ETFs especially. And then after I left Ameritrade, I started Zega Financial. Left on great terms, by the way. They still like me over there. Yeah, so we started as an RAA, which is a registered investment advisor. So we just started investing for individuals, and then we started investing for advisors because they found out like, hey, what you're doing in options is pretty unique. Believe it or not, most advisors don't utilize options because they took a test that included options, but they don't feel familiar enough to invest for their clients. So they hire people like me, they hire firms like Vega to go invest for them. And then we were doing that for years. And then in 2021, we launched our first ETF, which was our hedged equity ETF. So that's our one that's more about a protective investing, long-term growth, but taking out the big market dips, those kinds of things, lowering volatility, all that good stuff. But then we started doing these covered call option strategies and some others in late 2022. So the way that I've looked at this is it's just a matter of access. Of my advisor business, about half of it is either hedging individual stocks or selling calls for individual stocks. Like there's a real need for products like this in the marketplace for both advisors and individuals. And so, we when we launched the YieldMax funds, as I know you guys know, it was a little slow going, but they started taking off, and it's one of those things where success begets more success. That when you see a few that people like to buy, you want to put them out in other tickers that people also might like to buy. And the beauty of these products is you kind of get the advanced option trading, option expertise of active management, but in a very easy to buy wrapper of an ETF. You just spend the $20 per share, and now you got access to somebody that has a team of people that are trading them all day. So this is kind of, we think, with the YieldMax and Defiance brands, that we are kind of starting maybe a new genre of funds, kind of like when the leverage funds went live in 2005, right? The Directions of the world, the ProShares of the world. We think we're probably in the first inning of kind of redefining these ultra high yield products. I'll say options based high yield products. And it is more about distributions than yield. There's a little bit of a definition there difference. But look, I think this has been, what we've seen so far, wildly successful, more successful than we thought out of the gate. And it's communities like yours that are utilizing the exact way they were meant to be utilized, which is, hey, I want alternative income. I don't know much about options. Let me use a fund that's actually going to generate this kind of yield that's helpful for me. Now, I'm sure we'll dig into it a little more about kind of the dynamics of total return and yield and distributions and all that kind of good stuff, but I'll stop there.
Yeah, awesome. Let's get started. And I know there've been some changes going with YieldMax recently. So you mentioned that in ROD's interview. So let's kind of go through that and dive in. So,
Lion, before we start, yeah, I just want to share a few administrative things to Jay. First, just because you're new to Discord, you're going to get a lot of spammers. So we don't do private message. So just that's how we protect each other here. So if you get any private message from anyone, just consider they're spammer. Anyone, especially me.
In Discord? Okay.
Yeah, because once you out in the public, you got all these spammers gonna say. So I would just delete it, report it, and don't even answer any private message.
Okay.
The other thing is, Jay, what we like more than anything else is this a community that you can come in anytime and just hang out, and so this way on your drive to work, before, after work, you're going to see that this community is very busy. There's always people talking about it all the time, and we'd rather have you hang out with us and just fly on the walls, or just enjoy a cup of coffee and just listen to what some of these guys and girls talk about and their investment portfolio at the grassroots level. I mean, this the lowest level you probably can get here, and it'll be interesting. And you're not the only fund manager. What you will find out, there's other fund managers actually do hang out in our channel, and so it's not, you don't really require to participate in anything like that. You just hang out and watch and read the dialogue. We are heavily moderated in this channel, so a lot of time this troll in Discord, you got a lot of trolls, and we just ban them. And so it's one of the cleanest Discord I've been to, and it's well organized. So yeah, you're always welcome. So that's it. I just want to make sure the demonstration, and what we'll do is I'll turn over back to Lions, and then we'll give the opportunity for everybody to ask you a question, and that's pretty much it. Okay, Lions, it's back to you.
Yeah, thank you very much, Khmer. Let's get started with the changes. I know that there's been multiple changes going, and we talked about them. One of the most important ones that we talked is breaking up the single ETFs to the weekly payment based on the 4 groups. So we got Group A, Group B, Group C, Group D, and I understand that's going to be paid every Friday. Khmer, if you can share the screen, if you have it available, and Jay, you can hit that link when you see on the top of your screen. If you want to see the screen as well through Discord, that's another way for us when we're sharing data. That's also administrative stuff.
All right, I'll try to figure it out.
Yeah. So next to my name, there's live right now. So when I click on the screen, you can see whatever it's being posted. Oh, sorry.
All right, I see it. I'm there.
Yeah. Can you go back, Khmer, to the distribution table? You just shared that for a moment. Currently, it's the YouTube.
Yep. I'm going to switch screen right now.
All right. Thank you.
Here's the distribution table. Yep.
There you go. Jay, can you see that through Discord?
Absolutely. Yep.
Awesome. All right. So, I let you kind of speak a little bit about it, so that way we get alignment. I know that there's a breakdown here on the weekly, and we got the group A, B, C, and D. Please go ahead.
Yeah, so thanks. The first change that started, and you can see it here, is that the YieldMax and YMAG funds are moving to a weekly distribution. So we wanted to get something out there right away that just had the ability to kind of kick out weekly distributions as per everybody's request. You know, in the long run, we don't think, you know, my initial reaction to the weekly was, look, if we're just going to be paying out weekly, we're kind of accelerating, you know, payouts and not letting them compound during the month, right? But with YieldMax and YMAG, it's a little different because what you're getting is what you're going to get. Like YieldMax and YMAG received the actual cash from its holdings already last week. And so with those funds, because they are not doing anything with the cash, right? Earlier, we just get it and it would distribute it back. It was not a big deal to turn around and make YieldMax and YMAG weekly, right? We're just going to spread out the payments. Now, this first set of payments that's going to happen that we'll declare on this Wednesday will be, you know, about a third of the payments that we received last week from all of the single stock funds that are in YieldMax and YMAG. The following week, again on the 25th, we'll distribute the second third, and then on the final one, we'll distribute, you know, the final third on the 2nd of October. At that same time, the first group of YieldMaxes is also the first group of single stocks is also going to make its distribution, of which then that'll be the YieldMax YMAG distribution on the 9th. So recognize that there's a little delay between the Group A distribution. Once that Group A distribution occurs on the 4th, right, October 4th, right, we'll declare it on the 2nd, distribute it on the 4th. That'll be the cash that then gets distributed in YieldMax YMAG on the 9th. So a little bit of, I guess I'll say, transition timing here as far as how we're going to start paying out on YieldMax and YMAG. So that one, I think, is the easiest one for everybody to understand, right? Those are going to be just weekly payments based on what we earned from the single stocks. That's the first change. The second change is that we are going to stagger the single stock individual payments, right? And we broke them up into groups There's a little bit of a art more than science when it came to how we broke up these groups, A through D. But the first group of A that's going to get paid and announced on October 2nd, yep, you're pointing those out. That's the first group. Tesla's in there, right? We had to do Tesla first, right? Of all the ones to do first, it had to be Tesla first. Then we paired it up with its inverse crash. We broke up the Mag 7 kind of across these four groups. So I think it's 2212, right? The way that they're kind of broken up a little bit. And then, right, so that we have even distributions for YMAX and YMAG. And then every 4 weeks, each one of the single stocks ETFs are going to pay out. So now you're going to move from 12 payments a year to 13 payments, right? 52 weeks divided by 4, 13 payments. So, the dollar amounts might be slightly less, right? Because you're stretching it out over, over 13 periods instead of 12. But quite frankly, I think what this group knows, because you've followed us so long, that it's more about the volatility in the market that's going to drive what the distribution amounts are than it is anything else. And so, we know that these are not preset amounts. We know they change month to month. It just means you're going to get 13 payments now instead of 12. So that's kind of the big news here. And the reason we couldn't pay the individual single stocks, which is a question I get all the time, why not just pay all of them weekly? With the single stocks, we don't trade those on a weekly basis all the time, right? If you actually follow our positions or follow any of the YouTubers that follow our positions, because we know there's a bunch that do, you'll see that there are times where we may do a 2-week trade. You may see there's times we do 2 trades within 1 week. It was too hard to we thought it would actually disrupt the strategy, the integrity of the trading, by moving all of the tickers 1 week. So by spreading these out, it actually made this more palatable for us. We think that it'll still continue to have a more even distribution rate across the board. I'll pause there.
Yeah, sounds good. So, that's great. And that means that for YMAG and YMAX, going to be the rolling week. So 1/3, 1/3, 1/3. That's going to be paid, and then it's going to be adjusted based on after the transition period to be pretty much distributed on a weekly basis, and that's going to put us back kind of on track to get it based on what the fund earned at that time. Yeah.
That's correct. So like on the 9th of October, that will be the declaration date for the income it made from Group A that paid the week before, right? Because you have to get the payment before you can make the announcement, right? So that's all, right? So Group A will pay on 10/4, and then we'll announce on 10/9 how much actually is going to get paid out in YMAX and YMAG that week.
Gotcha.
Yeah.
Khmer, are there any question in the?
No,
in the
let's go ahead and throw it to the community. So, guys, all you have to do is unmute your mic and just say hello to Jay and ask your question away or have conversation. We'll try to do one at a time. So, first one to unmute your mic, I'll let you talk here. Go ahead. Go ahead and ask a question away.
Hey Jay, I got a question. On the specifically on the YieldMax or YMax, I'm sorry, the YMax fund. Is there any plans to potentially change that to like the top 15, top 20 situation where like maybe some of the let's just say not performing so well funds are dropped off?
Yeah, so probably not for YMax, but you have a really good idea for a fund that we have been talking about, which is, hey, we know that some folks prefer the high dividend ones and the ones that have the greatest kind of upside participation, right? The bullish movers that have a high distribution. And we know that investors will bounce between them, based on how they're moving. So what you're really asking for, right, is, hey, can there be a little more actively managed fund of funds? The answer is yes. We absolutely are considering that. So I will tell you guys one thing, right? I can't disclose anything that hasn't been filed publicly. Happy to always talk about those things, but so realize that sometimes I may hint at things that are in the works without saying they're in the works, right? But I will tell you this: on Friday, on that note, we filed for a fund in partnership with a company called Dorsey Wright. If none of you have heard Dorsey Wright, look up Dorsey Wright. The Wright is with a W, Dorsey, WRIGHT. So Dorsey Wright is a technical analysis firm that has kind of made their bones putting out funds that are all based on momentum and technicals. And so what we filed for on Friday was a fund that would grab the top 5 funds that met Dorsey Wright's technical indicators. And so what you might get here, this is just one example, by the way, right? That's filed, so that's why I'm talking about it. What you get here is a fund that is going to invest in what their triggers tell us are the best 5. Look, I will tell you there's some things I'm good at and there's some things I'm not. I'm not the person that picks winners and losers. I'm the guy that trades options on the underlying picks. That's always been what Zega's been all about. And while we do some of it with Alti, which we could talk plenty about Alti at another time on another second, but there are real, there's a real industry out there of firms that trade on technicals. And so I don't know if technicals is a term this group is used to, but it's, moving average crosses, RSI, MACD, stochastics, all kind of price moving indicators that'll kind of tell you which direction, the market is kind of indicating a stock will go. So to your question, YieldMax won't change because by definition and prospectus, it is kind of the universe of the covered call, the bullish covered call funds. You may see different funds, you will see different funds come out from us that have I'll say a rotational bias where it'll pick and rotate through the tickers, the underlying signals that look the best.
All right. Archmate, that was a good question. Go ahead and unmute. Hi, Div. This is from Hi Div. Go ahead, Hi Div.
Yes, hi, can you hear me?
Yes.
Yeah, hi, Jay. Nice to meet you. I have a question. Are you leveraging artificial predictive modeling techniques currently in your option strategies as part of your lab testing?
Only Alti. All the rest of them, it's pretty well defined. So if I'm going to interpret your question a little bit, and I believe what you're asking of, hey, if you're bullish on NVIDIA or MicroStrategies, do you get a little more leverage? Use the word leverage, right? Do you increase your exposure a little bit? Or do you sell calls farther away? Or if you're bearish, do you sell calls a little closer to capture more time decay, to capture more juice? And so the answer to that is specifically, with the exception of Alti, no predictive tactics are utilized in the single stock ETFs. The only thing that we do with those is, and we could talk about the third change, which we didn't talk about, which was the addition of the call spreads, which is, to me, is the biggest news of all of this. But will we utilize some of that when it comes to picking our strikes? And the answer is we will let the options market define which strikes we pick, and we always have. And so if you've heard any of my other interviews, I always say, first and foremost, the goal of YieldMax is yield and high distribution rates. Second is upside capture. Of course, all covered call strategies are bullish. The covered put ones that we have, the inverses, are bearish, but let's keep it simple. Covered call strategies are bullish, and we'd much prefer that, or I should say, the funds will perform better when the stocks go up. So, of course, it's something that we look at, but I would tell you that we let the options market define where we sell our calls. And also now that we're going to start adding in the call spreads, that's also a big deal to talk about at some point as well. But nothing when it comes to kind of predictive outcomes on the individual tickers, because guess what? I'm in them anyway, right? I have to be long them. So we don't take on and off positions. It's like it's hard to predict, individual stocks, let alone, what do we got here? 27 of them, 28 of them, right? So we let the options market do it for us.
And the second question I have is, do you have any interest in eventually having your own hedge fund?
So look, I've had 3 hedge funds in the past. The trick of a hedge fund is it's not about performance. They performed really great. It's more about finding hedge fund investors is always the trick. There's a limit, right? Some hedge funds only allow 100 investors, some allow 2,000. But I would tell you that in a lot of ways, Alti is like a hedge fund. And this is not meant to be pushing Alti. It's just you guys are hitting me with pretty advanced questions. And the reason why I reference is it essentially, right, we have freedom to pick any ticker we want. And right now we only have freedom to do covered calls on it. Soon, in about a month, we'll have freedom to apply any option tactic we want on Alti. That includes collars. It includes stock repair. It includes short puts as entry points. It includes spreads. It includes hedges. So we'll actually open up the floodgates on the tactics we'll use for Alti. So in a lot of ways, Alti really is kind of the hedge fund version for us. But like I said, I've had them in the past, and the trick is not what you know, but who you know. And it was always hard for us to distribute them, and the cost of them, we shut down all 3 of them.
That's excellent. Well, thank you very much, Jay. I appreciate your answer. Thank you.
Yeah, Jay, in our community, we have range of brand new, like we literally just help them open a brokerage account to guys like High Div, who's been doing option trading for years. So it's crazy, but in terms of range, but they help each other. And what we do here is I just share my portfolio, they share their portfolio, and it's just essentially a club of everybody sharing each other portfolio, and then just kind of like bounce off some idea of what direction we're going. But all of us have one thing in common, that we want dividends income, essentially YieldMax. So that's the one uniform effort that we all want. So it's a pretty interesting collective group.
I'd love to talk a little bit about kind of how you guys are using the funds. I'd even love to hear from folks that just started, right? That you've helped coach a little bit about, when you say you're using them as income, like help me understand, let's take Tesla, right? We're kicking out of 50.
If it's okay, I'll share you a quick story, and this is how I start my journey when I told the story, because of the first few people I met. I went up to New York to meet another fund, and I met one of the founder, and she asked me, what do you think of these high yield dividends? I said, these high yield dividends save lives. And it was shocked because everybody else was asking, they answer very differently, but I'm a military guy, so I said they save lives. And she said, what do you mean by that? I said, well, let me share you the story. When I first started this journey, we had a school teacher. She's retired, and all she wants to do is spend time with her husband, who's in their 70s. But she has to do substitute teaching in order to work because her husband can't work. He's a disabled veterans. And all she wanted to do is go out on dinner dates with her husband. And she just have enough money, just be able to pay the bills, pay the rent, pay whatever they need to pay, but not enough to go out on dates. So she had to go to work as a substitute teacher. So when I started talking about Tesla, and I think this time around 6 months into the investment, I was bragging to my family, like, look, I just made $30 a month. I can't believe it, because I was starting out. I started with zero and worked my way up. And this lady, she essentially moved a couple $1,000, enough for her to get $1,000 a month. That's all she need, $1,000. And she moved enough to get $1,000 a month, and she was really happy. And that's all she want is to go on dates with that. So that story is kind of like essentially everybody here. And what you see, the other thing is the working class, because they get paid cash. A lot of times, construction worker like my dad, he work on a roof. A lot of think a guy who work in the Chinese restaurants as a cook and stuff like that. So they don't make a lot of money. They get paid by cash, or sometimes they get paid very little. So when they get injured, this is the worst part. When they get injured, they can't go to work. Imagine you work as an asphalt repair on a highway. you get injured, you can't work. But these kind of fund, what happened, it give them life insurance. It's like okay, I can't work for the next 2-3 weeks, or they got no jobs. There's no contract job coming up, so then they can just go ahead and live off these dividend for now. And so there are a lot of people utilizing that way. You see there's people utilizing it because of work. They utilize it because of retirement, to help them out, to pay just the basic needs. And then there's people out there to maximize their growth, their fund, to make it get more rich and buy Lamborghini. So you got all kinds of spectrum, but majority of us here, essentially they need it for life, for daily life function. And so that's how most of them utilize. So does anybody here want to talk about that from their perspective and give some background? Like, for example, Bill, our truck driver, are you here? No, Bill, are you here? So Bill is our truck driver. We always tease him all the time if he's driving. Oh, yeah, he is.
Yes, sir, I'm here.
So Bill is a truck driver, and can you share your story how YieldMax helped you save your life?
Yes, first of all, my first career was in the United States Army. Basically a retired E7. And then after I left the military, I was, started driving tractor trailer for a living.
Here you go first.
Yeah. Well, I'm here with my wife today. I'm actually home, so we were listening to have an opportunity to hear what Jay have to say. And nice to meet you, sir. Really appreciate
Bill.
what you're doing.
Nice to meet you as well.
But anyway, I've been driving professional truck driver, owner operator since 2001. And actually my birthday on June of 2023, I turned 60. And I'm an owner operator, so I pay self-employment taxes, and I'm responsible for fuel. I'm responsible for my own insurance and everything. So, and I told my wife, this is, Social Security is not going to be very much for us. We need to do something about it. And she supported me and said, "Go ahead, start." So, our first foray into investing was in stocks such as SCHD, Coca-Cola, Home Depot, AT&T, that type of thing. The growth stock.
Yeah.
Growth stocks. And then, as I was learning how to buy stock, how to analyze which one is better than the other, or what is best for us, and trying to grow a dividend portfolio that would help support us when there's a major breakdown, or if something happens to my health, or an accident, or if I have to take time off to take care of a family member like my mom who's had surgery a couple of times in the last month already, or my family.
And a sister.
Yep. And yeah, we're taking care of my home. Well, I had her work today.
I just love how his wife is echoing in the background.
But anyway,
Yeah.
I think in October, I started looking for, instead of the quarterly stuff like like SCHD, I noticed stocks or ETFs like JPEY, not Y, but JEPI, and the Qs and other ones, and the REITs like Realty, and they were paying monthly. And said, we need to pick up the pace. I don't have 10 years or 20 years before I'm beyond the point where I can't work anymore and generate an employer or a business income. So I started buying that, and then I stumbled across JEPY or JEPI, and at that time, the JP Morgan version was paying about 40 cents a share, and I noticed this was paying like $1 or something per share on it from inception, when it first started, and I said, this is what we need to transition to. And I started buying that, and QQ Hawaii was the one, the Defiance funds. And then I would listen to YouTube videos from the YouTube investors, like Meet Kevin, and I stumbled across Khmer here, and I got hooked, really hooked. So I started selling out of my growth stock, and I started buying the Qs and Tesla and Coney and Misty and all of the high yielding YieldMax ones. And yeah, I dabbled in the round hill. I'm not going to lie, and I started growing my portfolio, and then I made my mistake. All right, dogs, you behave. And then I made a mistake in January when Coney started dropping in price, and the fear factor struck me, and I said, "Oh, here we go, we're losing it." And I knew at the bottom of my heart, it was just okay. This is what the stock market does. You can't win all the time. You get back sometime.
Yeah.
And y'all chill out, dogs.
So, Bill,
But
we're gonna have to move along a little bit. We want to give everybody else a chance to, to have,
okay,
yeah,
Everybody in the family has got.
just the final part is eventually my portfolio is pulling in about 10K a month, and I got my daughters going into high yield dividend. My wife is getting her own account going, and my sister-in-law's got one starting to this
yeah,
week. So thank you very much. We really appreciate it.
The question I have, right, for you,
yeah,
thanks, Bill, for sharing all that. The question I have is, right, so it sounds like you experienced a little bit of, hey, the market doesn't always go up,
yeah,
right? Think about
Oh
what we've
yeah.
gone through since the middle of July, right? Up, down, up, down. We're back up now. And, when you look at like the Coneys and the Misties of the world, they're tied to Bitcoin, which is having more volatility than even equities. The question I always have for investors is, do you understand the risk, right? Do you understand the risk you're taking in these investments? You don't get a 50, 60, 100% distribution without having very large risk on the other side. And so the thing I always want to make sure it's clear, and for those that have invested in the past, you understand this. Maybe for those that are a little on the newer side, you don't. You're taking stock risk, right? When you're buying the yield maxes, and I just
yep,
want to make
yep,
sure that people get that. And I understand if you're comfortable with the stock risk, and the point is, look, I just want the yield. I understand that I have the underlying risk. Then great. But look what Tony's done the last 2 months. It's 3 months. It's cut in half, right?
yep,
From 280 to 130. That's a big drop. And guess what? Our NAV on the funds reflect that. We're still kicking out distributions because I'm still selling calls every week on Coinbase, of course. And we're always going to kick those out. But your underlying investment is still the underlying stock. So I guess I would comment or ask, how comfortable is everybody with that fact?
Well,
Because
let me share you this, Jay. So when I went all in on Tesla, oh my God, there's so much hatred out there, because there's a lot of people out there think that your fund is a scam or is a fraud and all this stuff. And I was like, I'm a military guy. I work for the government. I'm like, what are you guys talking about? Like it's just so fraudulent from them to even to say things like that. And then you got the NAV erosion people. I never use that word at all to describe your fund, but there's people out there use it. But then they didn't see the way I see it. And just share with this. So what happened when Tesla price came down, because I was 98% my portfolio is in Tesla, I bought more. What happened was I saw the opposite of that. I saw the beauty of it. Like, I'm not going to get rich if Tesla was sitting at $30, but I will get rich when Tesla was sitting at $9. Why? Because I can get a lot of them. And so that's what happened to my portfolio. It literally jumped. So if I ever show you a diagram, it's like inverse. So as Tesla price came down, my portfolio went up in almost the same inverse relationship. And also my dividend went up. So I got more monthly income. And so what happened is that in this community, what we push for is cash flow, return on investment. Cash flow and return on investment. Get your money, and after that, it's just money tree for you. and because that's how you balance your work and life balance. Because if you're working and you're making $3,000 a month, let's say for example, and doing construction somewhere, well, your goal should be $3,000 per month. Once you get there, there's your reserve backup, and then continue on to grow. But at least you have your job reserve backup check off. So it's unbelievable.
No, that all makes sense, and that's important to hear that. We always talk about it's not about the value of the fund, the NAV of the fund. It's more about the size in your portfolio, right? Yeah. And so, you've probably heard me talk about, look, if whatever you don't need, you should reinvest back into the fund, right? Because then that helps compound your share count. If I could transition maybe and talk about the call spreads on what that's going to do for everybody here when it comes to the tickers, like Tony and Tesla, because Tesla had a pretty big drawdown as Tesla went down from almost $300 to when it got cut in half. But we've been on that ride, by the way, twice. So since you were in the beginning, we launched when Tesla was like $180. Within like a month, it was at $100. I was like, I couldn't ask for worse timing on that. But the challenge is with the covered call structure, you don't participate in the rebound, right? When we sell calls, we get premium, which we give to in a distribution, in exchange for the upside participation. Yes, we get some upside move, right? On an up day, we're up generally. But now with the call spreads that we're doing, we will still be able to generate our income. We're just going to bring that short strike in a little closer, and then buy another call on the other side. And so as the market goes up, we're participating on the upside where we previously would have been capped. So we're not still 100% all the way up, from 150 to 500, whatever the number is going to be. But we're going to get a lot more. And what that will do is we think it'll bring a little more stability to the price of the ETF, and it'll let us participate more in the rebound when the market does rebound and not cap us out, which is a lot of folks don't understand. That's the dynamic of all covered calls, right? Whether it's an ETF, whether it's JEPI from JP Morgan, whether it's QYLD from Global X, or it's from YieldMax, you're capped on the upside. Well, now with the call spread choice, we don't have to be capped on the upside. I don't know how many folks here use the GUI fund, the Google fund that we have, but it was a perfect example this week that on Tuesday, we rolled into a call spread when Google was down, and Google bounced hard. Normally in the past, we would have been stuck with a few points upside. But if you looked on the way this week performed, if you look at Google versus GUI, right, we got a lot of the upside move this week.
Yeah.
Right? So do you see how we are higher than where we started the week after the sell-off on Monday of what you're showing there on the screen, right? September 9th. And then if you take a look at, what do you got, the 5-day? Right. Normally we would have been stopped out, right? Where Google was at like 152, we would have been stopped out. But we did not. We kept participating. Yeah, flip back to GUI now. And if you look at what happened on September 12th and the 13th on GUI, we kept going up. Right, we still went up almost another. I'm trying to look there, right? Another few percent from 14.40 to 14.80. So 40 cents. Let's call it 3%. We got where in the past we would have been capped out. So that is a perfect example of what we think can happen with all of the YieldMax single stock funds. Now that we have that kind of a tool at our disposal, we won't do it 100% of the time. There's times where it doesn't make sense to do the call spread, but when you see that big dip. You always want to use it to catch the rebounds.
Wow, it's awesome. Believe it or not, I don't have a lot of baseline knowledge to even ask you follow-on question on that. But one of our sensei here, we call him our option trader master who can teach us. Claude, if you're there, can you unmute your mic? Say hello to Jay. So Claude and Huff is up here too. They spend a lot of time teaching us what a option trading, because one of the things when people are new to YieldMax, when they come into, especially when they come into our community and they just open an account, what they saw is the YouTube video and said, we made all these money, and they say, okay, I want to jump on board. But then they don't understand how the fund works. So the first thing I always say is, you got to understand how option trading works, because that's how they generate income. So I want to give a chance. Claude, did you catch everything he said, and do you have any follow-on question for him on that? Or
no, No, I'm with him what he says. Like I shared with you guys in the very beginning stages of Tesla, the way I was operating it. I was using what his strike prices I was using is basically benchmarks. So if he's taking it from one angle, if he's taking it from the call side, granted, yeah, he's capped at XYZ strike price, where I was using the credit spreads and capturing premium on the bottom side. So I was getting the best of both worlds. That's how I was using it. But like I said, that's just one way out of many that some of the traders in here was actually utilizing it.
Yeah, Claude, then you got the benefit of our higher distributions, and are you saying you used it to finance then a credit spread to the upside to then capture and unlock more?
Exactly. So I was double dipping.
Yeah. Well, so now watch when we do these, Claude, right? So by the way, you will still get the same distribution rate. That is the thing that I promise here. We are not going to forfeit that if we adopt the call spreads. But we still, you just bring the strike in one or two, and you're still going to get your same money. That's our goal. But yeah, so now you're going to get some more upside participation, the same distribution rate, and then you're right. Now you're really going to be able to double dip on the upside.
Yeah.
That's not for everybody. I understand that, right? But
right. You got to know what you're doing. It's almost surgical.
Yeah.
Almost surgical.
Yep. Well, that's great. Well, that's great.
Jay, also in our community, because we have a lot of brand new YouTuber, we have a lot of YouTuber that just start out. They have less than a couple of thousand subscribers, but they don't have they don't have a community yet, or they don't have a Discord community. So what they do is they join our community. So I'll introduce you to Jonathan Ball here. He has his own YouTube, but his community is in our community. And what you find out, Jay, is that there's a lot of communities out there. And they're all talking about high yield dividend space. Essentially, it's the same group of people. The same group of people that watch retired dividends, also the same group of people that hang out here and also hang out in Coach, hang out in all different places. And then there's some people are loyal to certain groups. So like there's some are loyal to just us and they only stay with us. But by and large, it's one big high yield dividend community is what I kind of discover within the YouTube world. And so I'll give Jonathan Ball here a chance to say, because he's from another YouTube spectrum that they hang out here also with us. Jonathan, you there? Because you unmute your mic, so I'm assuming you want to talk. Oh, well, he just left.
You called him out. He was it. He ran for cover.
I actually wanted to come in. Is it okay if I talk?
Yeah, by all means, by all means, that's it. That's the whole purpose.
The working investor. So first of all, thank you so much, Khmer and Jay, for setting this up. And this is like Jay, you mentioned that. I also have a question. You mentioned that this is the new era of investing. Never in my life have I ever imagined that we actually could talk with the fund managers like this. This is like, I feel like I'm living in a different dimension, my friend. So it's just I'm just like, honored to be talking with you, and thank you so much for setting this up. I had a question. So I'm basically a long-term option trader. I've been following Tasty Live, Tasty Mechanics, like Tom Sosno, and basically my specific question is, I've been using your funds kind of like so why I went to your funds. Then my question: I went to your funds because I was doing the wheel strategy. I was doing firing condors, and basically an option seller for many years. And my best return, consistently, was 24% annualized return. Of course, there were times where there were some downs in the market, and I had to put me out of commission. So I was looking at the returns that you guys were providing. I was like, you guys, without all the work, you guys definitely beat my 24%. Of course, I know it comes with risk. I understand the inherent risk, and you guys are doing a fantastic job. Here comes my question. So my question is, I've been using some of my name is like the sandwich man. So there's a term we have around here called the sandwich. I'm not sure if you've heard of it, where we've coined it using YieldMax funds with their inverse. It's unlike holding TQQQ or SQQQ or just holding it. It's more like basically we're looking like a synthetic covered strangle where we buy, let's say, let's say Tesla, and we buy Crash, and basically just by holding both together, you're getting premium. You're getting dividends from the premium from the Tesla side, and you're getting dividends via premium from the crash side. And then just obviously the idea why I do it is because let's say I'm just want to make for price stability. That's how I look it into. And I know that I read the prospectus thoroughly. I know it says in the prospectus that do not use it as a hedge, inverse funds. I know that, and I understand the risk that I'm taking, and I know that it's limited based on the strike prices of the put. There's no 100% black swan event. Both sides could potentially go down. I understand that risk, and
working investor, I know you're a little nervous here. I'm just trying to slow you down just a little bit. What is your question? Because I try to follow you.
My question is for Jay. You being on the mechanical side of things, what are your thoughts about? Is that a crazy strategy, or you think that's or you think that there's some? I know not to give advice, but I'm saying. Just like, do you think it's a little bit outlandish, that idea of using the YieldMax funds that way? Like,
no. So hey, thanks for sharing all that. That's great. Sounds like you are very well educated on this topic. I will comment that the reason why I like to engage with communities like this one is because option strategies require education and understanding. They're not like your grandfather's mutual fund where you buy it and when the market goes up, you go up. These are obviously different. That's why I'm out here talking to everybody. So I appreciate you also getting the word out. So to your question about the synthetic strangle, you nailed that 100%. You are spot on. Like I'm looking at last week, right? Tesla was up, 9%. Tesla was up 8%. Crash was only down 3%. So in that scenario, if you've created what I'll call like a quasi-market neutral position, it is not a hedge, as you so accurately pointed out, but it is a way to lower the volatility of your portfolio. And volatility is kryptonite for any portfolio, right? The whole concept of, if the market goes up, 30% and then goes down 30%, you're worse off than if the market went up 10% and went down 10%, right? That the extra volatility ends up being worse for a portfolio, right? Because when you go down 30, you need 43 to get back to even. When you go down 10, you only need 11 to get back to even, right? So that math, what you're doing here is you're reducing the volatility of the portfolio. And it's I think that it's why we put these out there. We also, there's two reasons. One, wanted to give an offset for some folks, so you're still getting your yield. This is the thing that I love about these. Like, I don't know any inverse funds that are paying a 50% distribution. Like, this is new stuff, right? Yeah. And so it takes time to understand all of that. But Tony versus Fiat, Tesla and Crash, right? NVIDIA versus dips. When you look at these, what you're doing is you're taking a lot of the market risk out of the equation and you are getting your distribution. Now, if the market really runs in one direction, yes, you could end up having losses, but you'll have less losses than if you only owned, or if you're on the wrong side of that trade, right? NVIDIA, I'm taking a look at it, right? This is a great example. NVIDIA up 15% last week, right? NVIDIA was up 10%. Pips was down 12. You're kind of neutral, right? Now, you didn't participate in the 10% up of NVIDIA, but what you guys are telling me is it's more about the distributions, right? It's more about the dividends.
Yep.
And great. Then you kept yourself fairly neutral. And when NVIDIA had the bad week, if you pick a different week and you look at that pair, Pips did better, right? So I think it's not a crazy way to use the funds. It's one of the two reasons why we put them out there, to let people kind of architect their own build. I will tell you, we use them in some of the portfolios we manage as an offset, right? So when you have a down market, I've got something that's making money and it's still giving me my distribution that the reason why I'm in it in the first place. So you're not crazy on that, Jonathan. It's fine. It's great. Again, you understand the risk.
Oh, that was working from the Working Investor Community YouTube. And this one, Jonathan's back. Jonathan Ball, are you back? I already introduced you a little bit. So since
Sorry,
you're
I
on
got,
mic,
sorry, I got your name wrong. My apologies, I missed it.
Yeah.
Sorry.
Jonathan, you there? Can you hear us?
Yeah, I know I am here.
Yeah.
Can you hear me all right?
Yeah.
Yeah, sorry, I had to bounce in and out there. But I just want to say, Jay, these are great changes that you've been doing lately and just fantastic.
Thank you. No, I appreciate it. But to the previous person I was just speaking with, sorry, I apologize.
Oh, no, you're totally good. You're totally good. Thank you so much. And Jay, you're 100% correct. I'm the most excited change that I'm excited about is what you mentioned in the video with I think retire and dividends, that the changing the prospectus where you could do those credit spreads to capture some upside. You know what I mean. That is like, wow, like that's incredible. Like, yeah, I'm super pumped. But thank you so much. It's been a pleasure speaking with you.
All right.
I also just say quickly, Jay, just while I have the chance, I just want to say, like, this is a whole new world where a fund manager of an ETF actually has like listened to the comments in the retail community and implemented actual changes regarding the weekly and to some degree this upside thing. And I just want to say, like, it's refreshing. We of course don't expect you to implement everything that everyone's asking for, but it's just the fact that you would take it under consideration. Never mind actually make real significant changes in a short span of time. I think it just isn't. It's just very refreshing, and so I appreciate it. Thanks.
You're welcome. You're welcome. I think the way I started when we were talking here, I told you my first job was helping the do-it-yourselfer, right? Not my first job, but when I was, before I started Zago and I was running the active trading business at TD Ameritrade, it was all about helping the do-it-yourselfer, whether it's giving them a platform, giving them the right tools. We put on free education across the whole country. Like, all of that was to try to help people be better traders. And I can't think of a better opportunity to do that in the institutional world. You're right. Most institutional money managers and portfolio managers don't come from the background I came from. They either came from sales or they came from, really high intensity quant backgrounds and things that are all helpful to make them better fund managers, but they're unable to connect with their investors because there's not a lot of channels to do that, right? In the past, you'd do like a webinar every quarter and hopefully, people listened. But this is a very different world that we live in here. And for me, it was ignoring something that wouldn't hurt the funds, but would help our investors was a no-brainer. Yes, there's costs associated with this. It's going to cost us more to run them. Costs money to file these things with the SEC, right? There's lawyers involved, and we all know that's not cheap. So yeah, but we think making this adjustment will help, spread the word, help investors use our funds more often, and ultimately, we see more people buying our funds, and even the new series of stuff that's going to come out, right? We are not done innovating. And so I think you're going to see more and more coming out of YieldMax and Defiance.
You know what's crazy, Jay, is that we have a lot of members in our community here, and somebody did the math for us because we have this club. If you scroll all the way to the very top, you see there's a 1,000 club, 2,000 club, 3,000 club, 10,000, 20,000, 30,000, all the way to 200,000, and so on. And so these are monthly income. So like I'm in the 10,000 club, monthly income club. There's people. So the average, we did the math. The average is $50,000 clubs or something like that. And if you did and then we did the math in addition, we essentially own 2.2% of your AUM. I couldn't believe that. And it's just like, and the entire YieldMax, because that's how much we invested in this thing. And it's just unbelievable. And we are really appreciate that you go out and teach. We pretty much watch almost all your video. And one of the reasons why we start talking about you coming in here for a long time, I try to not, because what we want is just what we tell people all the time. We make money not from YouTube, not from social media. We make money. We're going to get rich because our portfolio is going to be damn good. And that's how we do it here in our club, in our community. So, but what happened is we noticed that you always just, you didn't spread out, your wings. So I was like, maybe we should reach out to him and say, hey, come over to the Discord community and talk to all of us, because we do care too. And so we really appreciating your help you out being here.
Yeah, I'll tell you, right? So thank you, by the way, for saying that. I definitely want to reach out to every community that I can here, and thank you for being over 2% of our funds. That's amazing. I will tell you that, my job is trading, right? I trade the funds. I do the strategy on the funds. I'm not the marketing guy.
Yeah.
I'm the face of the funds, but I'm not the one that says, okay, these are the communities we should go talk to. This is how we get the message out there. And my apologies for not being here sooner, because you've been around with us we're coming on 2 years, and it's just a lack of awareness, right? Like it probably makes sense. I should hire somebody to help with our community awareness. But in all honesty, it's my primary job is more around the management of the funds than anything else, right?
Yes.
So, and you see how active we are, and I think that takes up a bunch of our time. But happy to be here. I'm sure I'll be back.
Yeah. U85, you're from Japan. You want to go ahead and say something?
Yeah.
Yeah, go ahead.
No, that's great. So first of all, Jay, thank you very much. I agree with a lot of the stuff that people have said on here, and I just personally wanted to say thank you as well. The funds are, really fantastic. And I've been trading options for quite some time, and it's mostly, because I live in Japan, so I do a different style, because I'm not in the market during the day, so because it trades overnight. So I do a bit longer term stuff. But I wanted to kind of understand from your perspective, you have a really strong in-depth knowledge of, options, obviously, and how you've set all this up. But as you're expanding, and getting into more different strategies, how is your team kind of maintaining the discipline and, avoiding, kind of emotional decision making, because the markets are really fast moving. We've got rate cuts coming up, everything's happening, and I'm just kind of would like to understand how you maintain that discipline with these strategies, especially as we're talking about expanding all of this, and how your team kind of interacts with that.
Yeah. So thank you, and good morning to you. It's the night for us.
Good morning.
Right? But so the simple answer is we let the options market tell us what to do. So if you see, we are probably some of the most active funds on the street, right? Especially when it comes to options. There are some tickers where we're, a large percentage of the action each week. But the discipline comes into understanding the priority of the investment strategy in the fund. So you guys have probably heard me say this. Number one is yield, first and foremost, right? But second is upside capture. So how do you do that? You're right, without getting jittery or pulling the trigger early. The very simple answer for that is we define our entry and exit points with our trade numbers, right? So anybody that's been trading a while, you know your price that you want when you get in. The price that means where you've made your money to get out. Whether you made money or lost money, you always have to define that price as soon as you get into a trade. We do the same thing. I will tell you a little bit of inside baseball, right? My team gets together every morning for an hour and talks about every one of the funds and what we're going to do that day and what are the different scenarios where we're going to react. But I will tell you this, like my team is expanding. Right now, 4 out of 6 of my team members are former floor traders, right? So we have a good pool to pull from when we hire folks, and we like to hire people that have a lot of options experience and understand that, look, there's a book you manage, and this is the way that you do it. I would tell, let's take, for example, YieldMax, right? This is the one we're talking about. When you've made 90% of your money on a short call, there's no reason to hold that anymore, right? So when the time value, we call it extrinsic, gets down to 10% or less of what you generated on income on that trade, time to look for your new trade, right? And because we have a target yield that we shoot for, right? I think everybody's heard me say this, that the implied volatility is the data point that we use to figure out which strikes we picked. It's very easy to say, let's say I sold an option for $1 and now it's trading at 10 cents. I look for the spot where I could sell for $1.10, right? I got to pay back, I got to cover my cost of exiting, and then my new strike that I'm getting into. So those are all well and good as the kind of the cornerstone of when you act. Now, is there going to be exactly an option trading at 110? Nope, probably not. So there becomes a little discretion of, well, do you do a mix? Sometimes you'll see that we do 2 strikes in a portfolio, right? Because it's like, well, I can get 90 for one. That means I got to get $1.15 on the other side. Maybe I get myself averaged out. Or we say, listen, go for the other one, right? Go for the upper side, right? Just make a little more. So there is some discretion that comes into it, but first and foremost, the goals of which we want to achieve with each one of those trades, that's defined before the market bell even rings.
No, that's great. I appreciate that. I mean, it's good to know that, you've got that kind of involvement with the team, with the daily huddles and stuff like that. But just from a trading strategy also, I mean, do you as a team get together and say, okay, here's the strike price, here's the expiration date, here's, like you mentioned, 90% of the trade, these are flat trading plans that, the entire team utilizes?
Yeah, pretty much, right? Like I said, that morning trade is we'll take a look and we'll say, hey, which one's getting close to our strike or which one's been beaten up enough. Let's watch for that one this morning, right? And there's an interesting dynamic in the ETF world where when you're active, like we are, market makers know your trades. They know our trades because they're fairly sizable, and so when they'll react to it. So that's why sometimes you may see a fund that, like, let's say we've got a call that's way in the money and our delta is now down to 0, right? We've pretty much tapped our upside and we're not moving at all. Well, we'll do a trade intraday. All of a sudden the markets will see us. They'll move us back to a 70 or 80 delta. Now we're moving in lockstep with the underlying ticker. So for those of you that don't follow option Greeks, I apologize for using the delta term. I know it's confusing. It just means the rate of change versus the underlying stocks. That's why sometimes you may see us not move very much and then move in the middle of the day because we decided, hey, the rules were met, time to do the roll, get into the next trade. So the reason why I bring all that up is that's all information that we talk about. Yeah, we'll talk about where we roll on our next strikes to, what's the strike price that we're going to go to. Now we add to the conversation, is it a call spread or is it just a call that we're going to utilize? What are the strikes we're going to pick for that? How far above the short do we put the long? Those are discussed in general so that everybody's operating under the same kind of guidelines and philosophy. But when push comes to shove, the team's in there and trading. Every trade has a second set of eyes that looks at it, but not every trade is deliberated and discussed. Everybody knows how to trade. Like, you get a day like August 5th of this year when the market had that, huge sell-off. It really wasn't a problem for us that day. Everybody knew exactly what they had to do. Go to work, cover your calls. Let's get out of whatever we need to get out of. So again, it's the benefit of an experienced team, the benefit of, group discussion, and then also similar, a well-defined philosophy across all the YieldMaxes.
No, that's really great because actually that was a follow-on question. Really great because actually that was a follow-on question I had was how you
Lions I apologize, Jude. So Lions, I was gonna ask one more question for Emily. Emily, are you out there? So I want to, you kind of met like 2 or 3. These guys they know option trading, obviously, but now I'm gonna just introduce you to some newer members, and they're just essentially starting out with investment. When they receive their first, dividends, it's so exciting. Emily, are you there? I remember Emily when she first came online, she was kind of scared about this stuff, and now she's, is jumping up and down like, it's just exciting. When you're new and you're getting high yield dividends, it's one of the most thrilling experience. Emily, go ahead and just unmute your mic and go ahead and say something, unless you don't want to say. Okay, when you're ready, just unmute. Go ahead. I'll turn it back to Lions. Lions, go ahead.
Yeah, I got a question about the topic that you discussed about the team conversation, Jay. So when you're looking at some of the rules set in place about putting the trades, are there any sessions like retrospective you do internally with the team to look at like what went wrong, what went well, what's the things that they can change or improve for going forward? So that way, it's a lot of in the corporate America that do this stuff when they do execution of things that, internally looking in retrospective and kind of making it's part of the decision making process, Yeah, has there been any times
That's
sort
part
of
of the
this
morning
guidance?
call. Yeah, that's
That's part of the morning call?
yeah,
Okay.
yeah, and we take a look at our positions and we say, okay, how did we get in this position? Why did we pick a farther out strike? And we just make sure that because we have a requirement to adhere to the prospectus, right? So
Mm-hmm.
there's not only an internal discussion, there's also documented communication to our compliance team that we are saying we've been within adherence of the fund. Now we have a lot of freedom, so only rarely have we strayed outside of the prospectus. I'll give you an example. We might have put too many short calls on one day because as we're rolling something down and closing out some synthetics, we found ourselves with a few extra short calls. That kind of stuff we talk about. All right, what was the process? Who missed this check? Absolutely, and then it's actually reportable to as the sub advisor, we have to report it to the advisor in the trust. So it's very
Gotcha.
rigorous on the reporting and analysis.
Yeah, that's great. Now, I have a question about the other kind of a new tactics that you are planning to employ. I would imagine it's going to be ULTY. Have you considered also using the put credit spreads just to capture also downside risk and protect the fund when there is a bearish
Absolutely.
trend?
Yeah.
Yeah.
Yeah, when I was rattling off before all the different tactics we'll have at our disposal, short puts below the market.
Mm-hmm.
Somebody mentioned the wheel before, kind of like a wheel approach. Around earnings is probably going to be something that we take a look at. So I can imagine us doing, a credit put spread. The spread meaning we'll limit our loss, limit our risk on the downside if there's a
Yeah.
real miss on earnings, and then using some of the income from that short put to buy an upside out of the money call. So think about is kind of a synthetic version of what we're doing. It's almost a reverse collar in that scenario. Absolutely, we'll use those tactics.
Awesome. It's going to be applied for all the single ETF as well, or just
No, only Ulti. Only Ulti.
only
So
OT? I got you.
only Ulti. The single stock ETFs are now only limited. So look, this is a pretty significant change to Ulti. It required an additional filing, an additional review of the SEC of those changes. We did not want to put all of the single stocks through that. We also thought it'd be way too confusing, quite frankly, to everybody. Right? Adding in the call spread feature really doesn't change much of the dynamic of the fund. The risk parameters are all the same, just a little different upside capture, but everything else is the same. Ulti's pretty major. So Ulti, again, that's why I say that's probably closest to like a hedge fund, whereas the single stocks are all just going to be, the calls and call spreads now.
Gotcha. There is another question I have about the call spread. I hope that it's going to be very interesting to also other traders. So we have the call spread where we have the long leg as well in that spread. Are you planning to introduce also two-tiered short calls in order to compensate where one is call is kind of blown out, let's say, during the trade for the underlying, and that other short call will be profitable?
I didn't follow the question. Give it to me again.
Sure. Okay. So you have the call spread where you have a short call and you have the long call, right? So that's the spread, right?
Yep.
Yeah. Are you planning for the one that for the short call, are you planning to introduce two short calls? So that way you'd be able to capture premium on different tiers on the short leg. And that way, if one is blown up and gonna up, it's still gonna be profitable at least for one, and the other one, if it's gonna going to be low, the second one is still gonna be profitable on the second short call.
Yes. So with that, we did that on AMDY this week, where one side was just a short call, one side was a short call spread. But what we won't do is have more short calls than we have long synthetics. So we won't get ourselves naked. That's not in line with the perspective. but we will
Gotcha.
mix and match the call spreads and calls together. Yes. Already
I
done it.
see. Awesome. Yeah, that's what I want to know. Now, there is a question about Defiance that I want to ask on behalf of Colby. I'm not sure if Colby is in the house. He's one of our option trader, and he asked me to bring up this question on his behalf. On Defiance, you basically announced that it's going to be 0 DTE based on the revision of the prospectus, right?
I mean, they were always had the ability to be 0 DTE. We just added the words to the prospectus. Yes.
Yeah. And then the question is that since JPY, IWMY, QQQY, and they're moving to daily options, that means it's not going to be overnight holding or exposure. Will SPY-T and QQQT will be doing the same thing?
Yeah, see, you misunderstood the change to the prospectus. We still will do the overnight holding. It's still the better trade. Selling overnight volatility still is much more profitable than waiting until the morning. We'll still do that every day. We will then just add in an intraday trade, the 0 DTE, same day trade into the strategy as the market dictates. And so there's different rules around that. Can't tell you guys yet because we haven't done one, but you'll start to see those happen. So there is no fundamental change to JEPI, QZ, IWMY. No changes to those at all, except we're now going to add in some 0 DTE trades when we think the one that we're on has made its money or it's the right move to make. But I wouldn't, you shouldn't expect major changes to those. We're still going to generate the higher time premium than our competitors. Quite frankly, you know, when I look at how much we sell in time decay versus our competitors, we're usually selling about triple to 4 times the amount of extrinsic. The difference in other funds, the other 0 DTE funds, is A, they have a little leverage, and B, they're built for more upside. They're more growth oriented than income oriented. So, you know, we'll probably give you a little taste of that, but the core build of JEPI, QZ, and IWMY is not going to change. We don't want to mess anything up there. It's what people expect. We don't want to really lower the distributions and the income rate.
Excellent. Thank you for the clarification. Yeah.
And then the QT question, no change to them.
Jay, we have a question from a new investor. He just want to know, Axel, why don't you just ask the question instead of me repeat the question? Go ahead and unmute yourself and ask the question.
Hi, Jay. I just wanted to know how many traders or managers are managing ULTY and MSTY, and is the ETF ZDHG, is that your creation, the hedged equity?
Got it. So 2 questions. So Ulti has 1 dedicated manager and 1 portfolio manager over him. For MicroStrategies, Misty, it's part of the suite. 1 manager has multiple funds. Misty just happens to be one of them, but also there's a portfolio manager over the top. I, of course, oversee all of the trading that goes on as well. So really, there's 3 sets of eyes on every fund. But Ulti has a dedicated manager because it is so complicated. To your other question about Z-Hedge, ZHDG, yes, that was our first ETF we put out in 2021. I think it IPO'd July 7th, 2021.
What's the acronym again? I apologize.
That's right. Z as in zebra, H as in hello, D as in dog, G as in golf.
It has a good performance, and I wanted to thank you.
Oh, you're welcome.
That was
No,
just my question.
Z-Hedge is just, yeah, there you go. It's our buy and hedge ETF. That strategy is meant to limit downside risk, but capture upside movement. It does have a little bit of a dividend. It's not the same as all the other ETFs we're talking about, but it's really more about kind of capturing the upside movement of the market with having a little bit of a downside hedge. There you go. But thank you for bringing that up. We don't talk a lot about it. It is compared to the excitement of YieldMax, some folks might find it a little less interesting, but for money you need to keep safe, we use that for our clients that have money and they need growth, but they don't have the risk tolerance of, say, individual tickers or the market in general.
Yeah, so Jay, what do you think of our community so far since you've been here? As you'd see, this format that we use, it's daily. We do this from 5 to 8 o'clock. roughly every day, but we do it, morning, day, night, and even in the different time zone because it cover worldwide. And what happened is new investors come in because either they heard us from YouTube or from Facebook or Twitter or wherever, and they just see the formats. What they see is they format because I provide no expertise. And all I do is moderate the discussion, and then what happened, they jump in, and you got the experienced investor, like the option trade. You can see you just talk to a lot of option trader already, and then they help fill in, answer the questions, and help them go along with the investment. So I'm just curious, what do you think of the group so far?
I think you have a really interesting mix. I wouldn't, I think the international aspect and the military aspect and the people that go to work every day, driving a truck, washing dishes, along with option traders. It's a really unique mix that you have, and I think hopefully it's a great litmus test of the investment community, and we hear everybody's thoughts here. And I know that it can seem, hopefully it doesn't seem too intimidating bringing up questions, but I've spent my life talking to, the beginner to the expert. So, I don't, if it seems weird, if you have a question, bring it up to somebody else has it, right? So I always want to talk to everybody about this. I really appreciate the.
Yeah, I'm glad you share your. Oh, while I'm talking, go ahead and unmute yourself. I see you unmute, and I'll call you out, and you can just come in and just jump in. So I do agree with you. There's fund manager that I met. A lot of time they just don't have the background like you have, and then it's kind of can be scary to ask. All the way down to the low level, it's just basic question when they're so used to dealing with at the higher level questioning. And so it's refreshing to you at the fund manager, at the CEO level, be able to talk about these kind of question. It's unbelievable.
Well, I appreciate it. Look, it's Sunday night. It's a weird time. I don't know how many people are. Thank you, everybody, for giving your Sunday night to ask these questions. Yeah, look, during the market, it's hard to talk to everybody because we're busy, right? We're running around. But, after market, of course.
Go ahead and unmute your mic and ask. Emily, are you back? I know you have a question for him, but I know you're shy. You're like, I'm not.
Let's have it, Emily.
All right. So go ahead and unmute your mic and ask. So, Jonathan Ball, you want to ask again? Go ahead.
I've got a question, if you don't mind. It's sort of vaguely connected to this, but I'm actually in the middle of reading your buy and hedge book that you wrote a while ago. I'm just curious to know if there's anything on the top. Is there any high level thing in that book that you, would maybe write or talk about differently these days, or do you feel the basic strategy is the strategy you're using? Are those still your 5 iron rules and so on?
Yeah. So thank you for that. So the book, Buy and Hedge, the 5 iron rules for investing over the long term, right? Wrote it in 2010. It is really what the Z hedge strategy is about. It is not necessarily so much about premium selling. The other gentleman that I do a podcast with, Derek, from my side, his podcast is called The Broken Pie Chart. We do that weekly. I would like to write a book about premium selling, whereas the first one is about taking volatility out of your portfolio, protecting. That's what buying hedges. Look, the iron rules and the still apply, in my opinion. You're right. There's 2 chapters there about understanding your risk. That's the only thing you can control is the risk you take. That's it. Everything else is out of your control when it comes to investing. And so define your risk, know what your risk is. That's what you can control. And that applies to YieldMax as well, right? I think what we're doing today probably requires a different book. There's so many different option and investing tactics out there. That one really just talks about why you hedge. And I would say we wrote it for the beginning investor. The first 12 chapters, I would say everybody should read that. After that, we get into the details of what a married put is, a covered call, and I think we hit on condors and diagonals, right? You don't have to get into all that. That book was written for the do-it-yourselfer who wants to trade their own portfolio and trade their own options. But everybody should understand those first few chapters, which is about understanding your risk, taking emotion out of it, lowering volatility, right? Hedging things. Long-term investing is what that is about. This community is a little bit different when it's about income. And like I said, this is kind of a little bit of a new genre, but that book is more about the longer term longer term philosophy, which still is absolutely relevant every day when we manage individuals' money at Zega. So thank you for bringing it up.
Great. Thanks very much.
And hopefully you like the movie quotes. There's a movie quote at the beginning of every chapter. Hope you like it.
Yes, I've enjoyed.
Jay, when's your second book coming out?
I know. It's in the works. How's that sound? It's in the works. Derek and I are working on it together. We're jointly writing it.
Thank you, Jay.
Cam with you. Jay, I had another question just about the mechanics. I know it's not written in stone, but let's say, for example, the spreads. Like, are we doing like for the short spreads or for the synthetic shorts? Like, are we doing like the 30 delta for the short, and then like I know there's like mechanics out there. Like when you do a $10, I've noticed you guys do $10 wide spreads. Are you trying to capture like 30% the premium of the width of the spread? Like I know the mechanics could vary, but what are the rough mechanics, if you don't mind sharing? Like
yeah. So look, that's a pretty detailed question and very technical. Here's what I would tell you: we start with the goal of the target income, right, and then work backwards from there. So yeah, typically we're selling a 40 delta on the spreads because you got to get a little closer, right, to the market, and then buying the long leg that still lets me net my income, right. So if my goal is $1 on a spread that I'm selling, if I'm paying $1.50 for the short leg, it means I want to spend 50 cents or less on the long leg. I mean, that's we don't want to make it too complicated. I certainly don't want to get tied into deltas because you throw a Misty in there versus say JP Morgan, which by the way, we did JP Morgan and Exxon spreads this week, right? And it's those are really tight, right? You don't always get the right, I'll say, striation in the option chain to get exactly a 40 by 10 delta build. So it all starts with the target income and then backing into the long leg. And if it turns out that long leg is just too far away because it's too expensive, then we'll default back to the short call and just go as far away as we can, like we always did. So hopefully that's a little bit of insight, but watch those. And the 10 is not deliberate, right? The 10 was convenient for Coney and I think AMDY. We used 10 wide on those, but it's not done deliberately. It just ended up working out that way based on the vol.
No, I appreciate it. We got a question for Dancing Nancy. Go ahead and ask your question. Or, I'm sorry, Dancing Nancy. All right, no questions. Dampish Ken, do you want to ask some question?
Yeah, sure. Hey, Jay. Just had a quick question because these used to be two funds that were the ones that basically started this whole weekly thing and no longer around. Does YieldMax have any intention of creating a fund that will pay a weekly flat distribution, like no change in it, and then pay the rest of it towards the end of the year, like a special distribution? Or is it always going to be whatever the call premium is, either spread out monthly or weekly?
Yep, I totally know what you're talking about. For now, there's no intention of launching a fund that has kind of a set distribution and then having a special end of year tax true up. And most of that reason is it's so the option income is so there's so much dispersion in the amount of money we make, week to week, month to month. It all depends on those underlyings, right? And you get a market that goes from a snoozer of like the beginning of the year started, and now we got a choppy market with a VIX over 20 a few times here, right? It's going to change, and I think it would probably be harder to predict what rate to set at the beginning of the year and then do the true up. The true up might be humongous, or it might be nothing, right? So I would say probably not. I will tell you there has been a discussion. And I think this group would absolutely hate this idea, just knowing who you are. There has been a discussion of letting the option income compound 100% and then doing a one-time at the end of the year. I don't think that would appeal very much to this group, but there are some folks that have said to us, we don't need monthly. We just want you to compound it as if you were trading an individual separately managed
Yeah,
account.
I can see that because we're probably not going to, we want weekly. you want to
You got to go weekly. Forget about yearly, right?
Yeah, they're like total opposite.
We're not going to change these to what I just said,
Yeah.
but there has been a desire to, hey, compound it. I'm just reinvesting it anyway.
Yeah.
So just leave it, and you do the reinvesting every trade.
That's interesting. Danzu, go ahead and ask a question.
Yeah, you can hear me?
Yep.
Yeah, so just had a question. How do you kind of, I guess, orient or inform like new investors communities that are coming in that are more kind of very traditional with dividend growth, REITs, they did BDCs, and all of a sudden in the market, all these high yields have kind of, popped up. How do you kind of assuade, or is there a learning curve, or are investors kind of just jumping in and, for the yield? How does that bridge happen? Because it kind of just happened in the last 3 years where everything has now become high yield. And those traditional DGIs and REITs, they kind of look, very boring now. And if we kind of reshift our capital, how do you kind of like bridge that knowledge to the learning curve?
Well, I mean, doing calls like this, right? Doing videos and calls like this is the way to get the information out there. And I'm not the only one. I know other portfolio managers are out having these conversations. So I think, and the great thing about this now is they're happening in a way where you just find them, right? You could find this information on your own. You don't need to be spoon-fed it from, a compliance-approved deck that has more disclosures than content and substance, right? So these are a great way to get the word out there. Again, it is still fairly new, and we shall see how this continues to play out. We're happy to be, one of the innovators in this spot. I just think we're in the first innings of this, but this is it, right? Having conversations like this,
Beautiful.
It's so hard to communicate this information in a white paper, right?
Right.
Who wants to read a 30-page white paper these days? They don't. Give it to me in Instagram of 10 seconds at a pop, and then I'll decide, right? Like, our world is changing a little bit here. So these kind of, I know we're on 2 hours, but but this kind of a discussion is absolutely the way we're getting it out there.
No, I appreciate you coming on. It's very good to have kind of a granular approach and a conversation. I've been enjoying all the comments you've given to kind of bridge that gap because it's all happening so fast in the high yield space, right?
That fast, very, very fast. Yep, I agree.
Okay, thank you, Jay. I appreciate it.
You're right. I mean, like a short duration high yield paying 8%, like that was wow. And now you're like, loser, right? Give me 50. We're spoiling a lot of people.
Yeah, we're spoiled. We're spoiled.
Yeah.
Yeah.
Yeah. One thing about this, before I turn it back to Lion here, one thing, this community, all this is free. People, that's the mind-boggling because we don't sell any e-guy, anything like that. And then not only that, I tell people not to subscribe, not to comment, not to like, and then we ban people. So it's crazy because what happened? We're trying to keep the noise, the conversation only to high yield dividends. And one of the things that I don't know how to help, I want to be able to explain it, is the number one question people ask me, or at least they hate on my portfolio, because I essentially own all YieldMax, is the NAV erosion. And I don't know how to explain that to people because, one, I don't have the background like you have. So I just tell, but because to me it's logical sense. As a military guy, I'm going like, this is the market condition, is to do with the underlying. Well, how come you don't get that? I just don't understand that. But what in return, I get a dividend income, return on investment, cash flow, and I'm going to get it for the rest of my life. I mean, literally the rest of my life, because I'm pretty sure Tesla is going to be around longer than I am. And so I just like, is any tips on how to help us with the elevator speak? Yeah.
The 2 second on this, right,
Yeah.
is if, we're going to have a 50% distribution. If we're going to pay out 50%, right, yeah. But the underlying stock and the fund only go up 20%,
yeah.
Right? So the growth is 20, but I gave you 50. That means you're going to see a price decline of 30, right?
Yeah.
But you still made 20 and got 50, right? Forget it. Don't worry about that NAV price, right? So this is like that's kind of basic math, right? If, hey, I had $100, it grew to 120, but you gave me back 50. then that's going to show a decline from where you started of that 30. So it's just, I like to just liken it that way, that the dividends are so large that again, we're so new here to this space that people just don't know how to look at it yet. People don't know how to consider total returns. We have to teach the world this. Total returns versus price returns. Those are two different things, right? The price change of the fund versus what you earn, including the dividends, right? So that's the way I explain it to a lot of folks. Just that basic math is it. You don't have to get into the dynamics of a covered call, limits the upside. You're only going to capture first 3% every week, but you're giving up. All of that gets really complicated. I think you could say it's just the concept is, if you made 20, but I gave you back 30, if I gave you back 50, you're obviously going to have this negative 30 influenced on the NAV. Don't worry about that. The whole reason of why you're reinvesting some of those dividends is you're adding to your balance. Don't pay attention to the price. Look at the size of your balance of the position. That's what's more important. In portfolio management, we build by balance, not by the price of the underlying stock, right? It's like, if I have $100,000, I'm going to put 20,000 in 5 different strategies. That's all that matters. I don't really care about the underlying. I know that I got 20,000 in each. That's the way that I think about it. I try to keep it simple like that. Hopefully that helps.
That's awesome. Go ahead, Lion.
Yeah, so we are looking at total return when we basically look at the value of our investment plus all the distribution that being distributed to us over the course of the holding. And that's like the communication and discussions that we've had with a lot of our members and outside of this group as well, to try to communicate the right way to look at the performance of these funds and how they can contribute to create cash flow. Because one of the key things for us as a community is to ensure that we get to generate income, and now on a weekly basis, which is great, and we all humble about it and happy about it. And also we want to make sure we get the cash flow in order to really be able to continue our life. And as you hear, a lot of people here dependent upon this cash flow to get in. I have a question from on the future side of the YieldMax. Have you looking at using artificial intelligence also as part of the way to improve performance? I've heard some new fund managers in other spaces talking about using AI ML as well in order to use this technology to be able to react to different market conditions, and that will help the fund manager to make a prudent decision on the spot or the right time.
Yeah, look, artificial intelligence has been used in Wall Street hedge funds for 20 years. We just called it something different. We called it algorithms. We called it machine learning, right? This concept has been around for a long time. So if they weren't using machine learning or they weren't using algos for price discovery, and now they just are, then they're probably a little behind the ball. So listen, I don't want to make too big of a deal about it. A little bit of secret sauce for Zega here, but yeah, we've always used that. You have to, right? And it's not only about picking the stocks or the options, it's also about your execution fills, right? I could find the greatest option trade in the world, but if I can't fill it with anybody, because I can't find somebody on the other side of it, that's a problem, right? So our fills also all go through algorithmic trading, all go through machine learning, even when we're trying to figure out intraday where to route our trades. So yes, that's all part of it. And it's always been. Look, AI is a buzzword, so yeah, we're using it, but everybody's used it. It's not a big deal.
Yeah, that's good. Yeah.
There you go.
Yeah, absolutely. That's great to hear. I just want to make sure that coming from you saying that, because I know that's been out there for many years, and I just want to make sure that you guys doing that decision-making process as part of that. I have a question about the statement 19A, which is the one that providing the classification of the contribution that made. Since it's going to be weekly, some of those funds, are you planning to introduce in the website the statement 19A-1 on a weekly basis so we can see the breakdown between what is ROC, what is going to be, a short capital gain? Yeah.
Yeah, so for those of you that don't know what the 19A1 form is, basically it's a document that gets put out 45 days after the distribution that shows what percent of the dividend was income and what percentage of the dividend was return of capital. You use the term ROC, return of capital is what that means. That document will still go out 45 days after the distribution, right? No change there. Remember, not every fund is paying weekly. So the rule is if you had return of capital, you need to post that document 45 days after the return of capital. So, if we have a distribution and Coney has return of capital 45 days later within, I think it's 40 or 45. Again, by the way, this is not my area of expertise. I'm the trader, not the administrator, but I'm helping because I know the rule. They're going to post that. So it's weekly. If every week there's something that has return of capital, yep, that'll go up, that'll get posted.
All right. Is there any intention to use Section 1256 for contracts, like in defiance when they use the indices?
All right. Much more complicated question. Section 1256 contracts get a tax advantage treatment. I'm going to punt on this one because it's complicated and I don't want to give advice. But what your broker statement will include any benefits on the 1099 at the end of the year when profits were treated in the 60-40 manner, 60% long-term, 40% short-term. That's what a Section 1256 contract is. But again, this tax stuff is it gets technical, and I would say I am not an accountant, and you can consult your
I
own.
agree with you, Jay. I have no idea what you guys are talking about. So let's go back to some newbie question, if it's okay.
Please.
Oh, one thing we didn't talk is, are you okay to stick around some more, or I thought we've got to establish the timeline here. I'm all up to you,
As long as you're giving updates on the game, then I could keep.
Okay.
I'm kidding. Yeah, let's keep going.
Okay. We got Rags.
Yeah.
Rags, go ahead. One of our newer Rags.
Hey Jay, thanks for taking time and coming to Discord. This is pretty invaluable. So my question is, do you guys have any plans on releasing the inverse Misty anytime soon?
We have not filed for that yet. I think we filed for 5 out of the gate, 5 or 6. We just have 2 left that we have not launched. Misty was not one of those. I can tell you if we did another filing, Misty would absolutely be included, but we have not filed for that yet.
Okay. And another request is like maybe you can consider this as a request, I guess. I mean, is there somehow you guys can make a basket of inverse funds, and such that we can have what I observed is like during market downturns, portfolios are going down pretty hard. I know individual stocks are going down, and we always see red in the portfolio. Somehow, is there somehow we can? I know you talked about
inverse. Is that the question? Basket of inverse?
Yeah, basket of inverses.
Yeah, like a wine min, right? That kind of a deal. So I would tell you,
YieldMax, wine min.
Again,
interesting name.
Yeah, it is, and I would tell you we have not filed for it yet, but you could probably assess if we're thinking about it because I've already given you the ticker.
Wow! Look at this inside ballpark. YieldMax and wine min.
There you go.
No, that's cool. I do some options I do inverse funds on the options. But there's no way you can hedge your portfolio if you're on high yield investing. So
yeah, and it's hard, right? The liquidity on the options of our tickers is building, but is still low, right? Like some strikes, you have 1,000 contracts outstanding, which is actually kind of great, but there's not enough liquidity in the price to get a tight market, right? So if you're doing options on our ETFs, use limit orders, right? Use a little self-discovery there. Just don't bang them against what the market gives you. Put them out there. It'll get picked up. I'm with you that there's a real utility in the short side of things. I wish that we had more folks owning the inverses. It's just a harder concept. And I could talk for hours on the wonderful benefits of a short portfolio, and it still might not even matter to some folks because they won't get it, right? So but I think they're great. I think they're important. I'd love to do more of the inverses if we can.
I have one more last question. Maybe this is a stupid question, I guess, but so is there any possibility that one of these ETFs can do a forward split?
Sure, there's the possibility. I don't think we would rush to do that, but there's nothing that would prevent it. I should say that, right? Like if it got up to the point where all of a sudden one's trading at, like Misty was a great example, right? Launched that thing at 20, within 3 weeks it was trading at 40, right? What you might have noticed from our most recent launch, which was SMCY, which launched I think Thursday or Friday, or the 12th, I think it started trading. So that would have been Thursday. SMCY launched at $50, right? It's the first time we've launched one at 50. We'll probably continue to launch them at 50 going forward. So if we had launched Misty at 50, it would have been 120 within the first 2 weeks. There's probably a number where we do a forward split, a normal split, but I would say we'd want it to be a sizable amount to make sense to do that. Like, you don't like disrupting people's position size if you can. There's all kinds of costs and all those types of things. So to me, and actually the dividend, while you'd have more shares, would go down, right? And I think everybody wants dividends up. So yes, it's possible. I think it's probably unlikely.
Well, thank you, Rex. We have a question from NC. NC, go ahead, ask some question.
All right, thanks, Khmer. Thank you.
Yep. NC, NC 1701, are you still there?
Yes.
Yeah. Go ahead.
Hello, Jay from California. I was wondering what was the security, the SEC regulation that allowed this type of high-yield trading?
Yeah. So another technical question. So I believe it was the 18F change in 2019 that allowed you to be concentrated with certain holdings like treasuries, and allowed derivatives to be a large portion of the underlying holding in an ETF. So it's about a 4-year-old rule now, but it was 2.5 years old when we first started filing for our ETFs in 2022. So it is fairly recent, which is why you haven't seen so many of these. And we like to say it's a little bit of a regulatory opportunity that we took, and we wanted to be early and be innovative on this with the single stock tickers. And there's some rules around that and derivative guidelines and things like that that kind of unlock this ability. And again, I'm not a lawyer, right? But so I can't, regulatory lawyer, I won't go too deep into it. But yep, it is fairly recent rule. And as long as you're doing certain tests every day against your price movement, against your benchmark, and you remain certain limits, it's actually why you don't really see any more triple ETFs coming out, right? They limited the amount of leverage you could have, for example. So we run into things like that when you get a really volatile ticker like, MicroStrategy Coin or AI, where, some of those rules kick in that, make you take some leverage off or make you reduce some volatility in the portfolio. So there's just a whole set of rules that allowed this type of fund to be built, as long as you're following certain rules that were kind of new. And so that was it. It's like 2019 is what really pushed all this.
2019. Oh, okay. Thank you for jumping on this type of alternative investment. It's really an opportunity.
I'm glad you like it.
That's awesome. All right, go ahead, guys. If you unmute your mic, I will call you out. Mark, go ahead and ask some question. And
Hi,
thank you,
Khmer,
NC.
can you hear
Go ahead and
me?
mute your mic, NC.
Khmer, can you hear me?
Yep, I can hear you.
Okay, Jay, thanks for coming on. I wanted to know, what is a question you wish more people would ask you about high yield ETFs?
Oh, that's a good question.
Yeah. And we've covered it here, right? It's the question I always want people to understand is, how should I use this in my portfolio? I'll tell you, almost every one of my advisor calls. So we have advisors that are starting to become aware of the funds because their clients are trading them, not because they were looking. And the question that I love when they ask me is, all right, help me understand how people are using these in their portfolio. Help me understand what you do, Jay, as an advisor for investors that use these. And, it brings me to the risk question, the risk conversation, which to me is, if everybody understands the risk, again, I go back to it, it's the only thing you can control. Understand the risk that you're taking in these funds. And by the way, I'm not trying to scare anybody. The reality is you take stock risk when you own these ETFs. All there is to it, right? Yes, maybe a little less, but you have stock risk. And so that's the question that I wish everybody would always ask. Like, what should I look out for? What are the gotchas? Like, what are the things that can really get me? And I've talked about it, right? It's the upside capture is being limited, as long as you're comfortable with that. The high distributions that may make the NAV appear to decay, not a term I like to use. It really isn't NAV decay that we have. NAV decay is typically associated with contango problems of futures products or compounding problems with leverage products, or neither of those. This is just the decay in the price of the ETF is associated because of the high distributions. So stock risk, explain to me why the NAV seems to always go down. Those are the conversations that I want to have to help people understand, the concepts of total return is really important to look at. And then the concept of knowing that you're taking stock risk with these. Historically, when you hear yield products, you typically think bonds and safety. It's not the case here, right? Like, again, I said, we're kind of putting out this new paradigm of investing, we think, starting this new kind of style of investing. And so just people understanding the risk to me, once they get that, then all is good. I usually I spend way too much time on risk, but it is really important that people understand that. Thanks for that question.
Yeah, I think it's a very, very good question, because that's literally one of the things that people ask me all the time. And so the way I do it, I just show them my portfolio and I show them my journey and how I just did it. And I just said, okay, this is how I did it and this is how I get to where I'm at. But when I start off, I only make like $50 to $100, and I get to $1,000. But I just commit to the plan. So I had this strategy and I just commit to it, and that's how I explain people. But the way you explained it, I didn't think about talking from a risk perspective. Just
make sure they understand what they're getting into, right? Yeah. And you're comfortable with that risk, right? Yeah. You're like, look, if it's down, I buy more. Yeah, when you get a distribution, you buy more, right? Yeah. Then you're comfortable with the risk. You understand the dynamics of the fund. So, yeah, and you're not an advisor, so look, you can say what you want, right? Yeah. You probably don't want to lead people too far down the wrong path. As long as they're comfortable.
No, there's no one here. We always talk about it. We only share our journey. Everybody share their own journey. And you want to hear something crazy statistic here, Jay? So there's thousands of us in this channel. When we first started off, there was only like 4 or 5 funds. You got Tesla, Clip, ORK, and then I think we invest in Bitto. And then we're talking about things that pay 50% or higher yield at that time. And now there's like literally a dozen. I mean, I lost count. There's so many. Think about this. There's not a single person in our community invests exactly the same way. Isn't that crazy? You think there would be one person who would invest exactly the same way. Now, in other words, it's the exact same portfolio. Everybody have their own portfolio, and everybody discuss their portfolio among the group. And you think that, oh yeah, you have the exact same portfolio as mine, but it's not. Everybody would have some kind of more on Tesla, or more on Coney, or more on Misty. Some are Bitcoin heavy. Some are just a matter of fact lower yield. Some have a combination of all kinds of stuff. It's just crazy how there's not one single person invest the exact same way. You probably didn't guess that.
I'm not surprised. Every one of our investors that we manage for always has a different goal, has a different risk tolerance, right? Yeah. There's no 2 clients that we have, individuals, that have the same build. So I'm not surprised at all.
Yeah, and especially the more diverse the more option we have. The part we love about now compared to last year is that there's so many options now, which is what got us all excited. Especially when you go into this weekly option, we got even more excited. Well, no, can you walk the dog on why how do you get started in this weekly discussion? I know we talk about weekly way the beginning of the journey, but but you and I never connect, or our community never connect. But I'm assuming you just did this independently, or you just heard stories, conversation.
Yeah, no, this is. I think I get the question there. I mean, this is. I'll just cut to the chase here. This is a great opportunity to connect. The change to the weekly really came out of this inflow. I secretly think somebody started a campaign to email me, because I probably received in my work email, not in my personal, but my work email, probably 30 emails in the period of 2 weeks. Right? You were one of them.
Yeah.
Lion was one of them that reached out to me, and look, it seemed like, hey, dig into this. The people want this. Is it going to hurt the funds? Can we accommodate? And if why not? Right? I mean, like, I will tell you this. Right? So full disclosure here. While I love the idea of YieldMax and selling options and distributing the big dividends, I knew that we would have a problem with the price decline. Right? And I told our partners, I said, look, we're going to kick out these prices, and people are going to have to get. I don't know how well the community is going to accept something that goes from $20 to $10 over 2 years, because you've been kicking out super high distributions. And I'll admit, I was hesitant to jump in with both feet into YieldMax, and I said, all right, let's do a couple. That's why we only launched 2, and let's see what the adoption looks like. And it was a little slow, like anything. It was a little slow, but once it started gaining momentum, it was like this unstoppable force. And I said, okay, people want this kind of an investment, so let's accommodate, right? Let's start cranking out the YieldMaxes. Let's crank out funds of funds. Let's do an Alti. Let's start doing like the Dorsey Wright filing I just mentioned. Let's start doing more and more of these. And so accommodating the weekly topic is just a natural kind of the natural evolution of the way that these funds have launched, because people want them. Why not give you what you want, as long as it continues to be, allow us to run a viable strategy and doesn't impact negatively the people that are in the fund already. So I would say that's how we got here with the weekly, right? A lot of people were asking. It didn't really matter all that. Once we figured out the offsetting,
yeah.
By the time I got an email from Lion, we had already worked it out, but it was nice to see kind of application and justification exactly the way we were thinking.
What we talk about, I'll share you a statistic we talk about here all the time, is that and this community is a small snapshot of these statistics, because the people want it, because they need it. Like a lot of other community crush us on this. They always beat up on it. They're like, hey, why do you guys want weekly? Why do you guys always want to talk about weekly? We always believe it's the holy grail of investors, because if the fund manager can give us weekly, oh my God, there's so many options, so many choices that we can utilize in our daily life. Because see, we use our money to live, to help our incomes. So think about, I'll just throw some statistics. There's 16 million veterans out there, and once they switch from active duty to retiree or disabled income, they get monthly paycheck. So those guys want weekly, because that's what they're used to. You got a lot of federal, local, state, and police employees, so a public servant's job, a lot of those jobs are essentially monthly payments, so they want that. So they want weekly pay, so they can pay out their bills and stuff like that too. And you got people on Social Security and some other, and then you got the travelers. You got the prison, the students, and they all want weekly pay too. So when you add them all together, I mean, we talk about almost hundreds of millions of people that get monthly, and they're like, I don't want monthly. If I can get weekly, they're going to get weekly. So you answer a lot of questions. I think this is going to be very popular, and I don't know if you did any marketing research on those things.
There wasn't enough time to do marketing research. I mean, seriously, a marketing study takes months, right? So, look, we live in a community. Like, think of most of our bills are monthly. Like, most people don't have weekly bills except paying for groceries and gas, right? But so we thought monthly should have been okay. When we started, we definitely didn't even know if we wanted to do monthly. But I thought, okay, if we're going to do this, let's do that. But I get it. We're here, and let's see if it makes a difference. Let's see if if more folks buy the funds, or if it ends up helping with compounding, all that kind of stuff. We're gonna see.
Yeah.
We're kind of living on the edge with this one.
We got a couple more questions. I got Coffee Holics want to ask you questions. Go ahead, Coffee, and then I got Boosted want to ask. Boosted's gonna wait for your turn, and Devon Asia, you're gonna wait your turn. So Coffee, go ahead.
Hi, I was wondering if you plan on making the OT also into a weekly payer.
Ulti will be included in the schedule. I think it's in Group D. So Ulti will still be monthly, but in the rotation. Again, hard to do when you're selling weekly calls to do a weekly distribution. It doesn't. There's too many times that we'll roll a call early, or we'll go out to the next week. There might be times where it's a 2-week trade. Some of the underlying stocks in Ulti only have calls on a monthly basis, so I couldn't really do it. So Ulti will not go to weekly all by itself, but it'll be in the weekly rotation with the other. There you go. It's in Group D. If you look at the screen share, I think it's in D.
Group C right now is Group C in Ulti.
Group C.
I forgot it was D. We moved it to C, so it's in Group C. So it'll get its first payment, this week, and then a month.
Sorry, I didn't mean to cut you off. I apologize. Boosted, go ahead. Ask your question.
Thanks, Jay, for being here. That's first and foremost. Second, as far as what data do you see? Because now you say that the ETFs that you're bringing out is now going to start somewhere around a $50 range. What data do you see that these prices, as far as the NAV erosion, won't go to 20, or the majority of the ETFs that you currently hold now is around the 20, 21, 19, 18 range. What data that you see that it won't drop, the NAV erosion won't go from 50 to 20?
It could. It absolutely could. The $50 price point won't prevent the decline. I'm going to use the word decline and not erosion. I'm just sensitive to that one, but that's okay. It's what everybody uses. It's totally fine.
No, we don't use in this community. We try not to use it. Yeah.
I'm kidding. So look, take a look at Coin. Right, this is a perfect example. Right, Coin, the underlying stock got cut in half over the last few months. Well, if that happens and the ETF is, let's say the ETF's trading around 15, we're going to drop to 7 or 8. Right. Has nothing to do with erosion or anything that has to do with the dividends. It's because the underlying dropped, right? So what happens is you got to do a reverse split, like we did the reverse split with Tesla, right? And that was, nobody liked it, but we also didn't want the price to drop to $5 or $6, and then all of a sudden brokerage firms start restricting its access. They don't let you use it on margin. They don't let you so. It all of a sudden it just gets complicated when a stock drops below, or an ETF drops below $5. So the reason you go to the 50 is that before we would have to do a reverse split, you're going to have a pretty significant drop. But if Coney was $50, well, look at MicroStrategy, right? It was in the mid 40s at one point, and now it's significantly less because of all those dynamics. So it absolutely still can drop. That's not the reason. The reason is we don't want to be forced to do reverse splits because the underlying stock, which we have no control over, ended up dropping. That's really the main reason behind it, is to reduce the frequency of reverse splits. But sure, a $50 price on the ETF could go to 20. Sure, that's certainly possible.
Yeah. All right.
Thank you.
Yeah, thank you, Boost. Go ahead, Devon Asia.
Hey, how you doing? You actually kind of started talking about what I was going to ask. All your future ETFs are going to come out at $50, correct?
I think so. I don't think it's like a hard set rule, but that's the assumption.
Yeah, my other one was actually about the reverse split. If a reverse split does end up happening, is it going to go up to $50?
Probably, like the 40, 50 range. Probably, we haven't announced any of them, so again, it's a little speculation here. But I think it's safe to assume we would do that to reduce the number of future reverse splits.
Okay. Yeah, the previous question kind of led into what I was going to ask. Thanks.
It's good. I think that's a lot of folks have that question. If I can make one comment on reverse splits, right? A reverse split is not necessarily a negative thing, right? It's done because the price dropped, but all we're doing is saying instead of having a $20 bill, you now have two tens, right? Or instead of having a $20 bill, you got four fives. Your share count goes, it's the same value, right? It just, and by the way, the dividend will increase per share when you do that, right? So everything kind of just, your shares go down, but your price goes up and your dividend per share goes up. All of it, you don't lose any value when you have a reverse split, but there's this negative connotation because historically a reverse split meant the company was like going out of business or whatever the reasons were, but that is nothing to do with what we do. And if you look at a lot of the leverage funds, they do reverse splits all the time. It's fine. It won't change your distribution rate. It won't change, the growth patterns. It's just, hey, you used to have, two tens, now you got a 20. That's all there is to it.
Wow. Yeah, it's an awesome question. Lion, before I give it back to you, PP Humble want to say something. Go ahead.
Hey, good evening, guys.
Yeah,
Go ahead.
Yeah, good.
Hey, Jay, thank you for everything you've done with these funds. We appreciate it. I know I came in late, so I had two questions. If they've already been answered, then just let me know, and then we could go to the next question. I was wondering, in the future, do you plan to release more funds that pay weekly? That's my first question.
I would say, an individual fund, we might do that with more, so nobody asked that question, by the way. We might do like more fund of funds. If there's those, they might pay weekly, because again, who knows when they're going to get the dividend from the mix, like more YieldMax or like, the top five, right, that I talked about before with Dorsey, right? I don't think, none of the single stock ETFs will go to weekly, but they'll get worked into the different groups, right? So we'll spread them out. Like, the SMCY, you can see is in Group D, and it's going to get its first payment at the end of October, right? So that was a new fund that got put in. It's going to have its first distribution. That'll just be part of the mix in this group rotation. I think the Defiance side of things, a good question. We're moving to weekly on a lot of those. It's okay to go weekly because we're closing our trades out daily. So maybe if we have more of the Defiance funds that have a more frequent, full trip trade, like a daily trade, those might have some a weekly cadence. Hopefully that helps.
Yes, thank you. And then my second question, if it hasn't been already answered, some of these YieldMax funds, they haven't really been growing as much as others. Is there a plan for those in the future to kind of help them grow, or what's your thoughts on that?
Growing, you mean price growth or size growth, asset growth?
Asset growth.
Asset growth. Look, I'd love for all of them to go up in asset size, right? Full disclosure, we make more when that happens. Right, the bigger the fund, the more fees that end up getting charged. But so full transparency there, guys. Right? We it's not a charity. We get paid to do this. I would tell you, when you have like the YieldMax and the YMAGs of the world, those help build up the size when you have a fund of many. So there might be some more scenarios where that assists in the size of the assets within the fund. Doing sessions like this and creating awareness is also, a way that hopefully the word gets out. I would say the biggest hurdle that we have, like we've had this amazing, remarkable growth out of the gate, right? Between YieldMax and Defiance, right? Like $5 billion are in the funds now, right? I mean, that's an incredibly huge number in such a short period of time. However, we haven't yet cracked the wirehouses, like the Morgan Stanleys, the Wells Fargos, the Merrills of the world, because they need longer track records. So, usually you have to wait till 3 years before you have that. So it seems like it's more of a matter of time before you can get adoption by the much bigger houses now, including them in their portfolios. So this is the natural kind of process for growing assets. Really at 2 years, we're still very, very new in the space.
Wow, that's interesting. I did not know that. That's an interesting factoid, and just from a fund management.
Yeah, I mean, the retail investor, the do-it-yourselfers like you guys, you have an advantage of speed, right? You can be first, you can be quick, right? It takes time for those big institutions to adopt, especially a new style of fund like these.
Yeah, that's awesome. Joe Melson, go ahead and unmute your mic, and after that, Neo, you're on the waiting list. Go ahead, Joe.
Hi, Jay. Thank you for coming in. I have a question. I know that you just recently released the YQQQ. Do you have any plans in the future to release like maybe the Russell and the S&P 500 version of it, or do you think that's not a good idea because you're a sub-advisor for one of the major competitors, and also, is it a chance that those, since they're like indexes, might be weekly pairs?
Yeah. All right. So with regard to more indexes, this is the YQQQ is the first index that YieldMax is kind of weighted into, right? Yes, we use for Defiance, we use indexes there, right? Those are more index focused. So this is the first time that we have an index. I think we haven't filed for more. I keep saying that term filed. So for anybody that wants to know what I mean, that is, before I can really talk about anything, it has to be there's what's known as a prospectus filing, where you give it to the SEC and it's public knowledge. There's a website that lists every fund's prospectus. When we publish it, and that's called filing, we give it to the SEC. We could talk about it. So we have not filed for any additional reverse indexes, but we're waiting to see what kind of adoption we get in YQQQ. So far, it's been lightly adopted, right? I don't think it's had much growth outside of the seed money that's come into it. So do you have an AUM there on YQQQ as you're working there? Thank you. Actively sharing your screen. So let's see, where is the AUM? 3.5 million, right? That's probably one of our smallest funds. So if nobody wants these, we probably won't do more, right? There is always a business decision here. In the upper left, the first data point, right? You see where it says assets on the screen, right below the overview tab. There you go. Yeah, that is, until people seem to want more, I'm not sure if we're going to do more, right? Again, this goes back to when people want something, we'll do more. When people don't want it, we won't do it, right? It doesn't make sense to do them just for doing them. So hopefully that answers your YQQQ question. And then the weekly dividend, this one is not a weekly. This one is a monthly dividend, but into the weekly schedule, right? The 4 groups. I think, inverses are always interesting. There's a real space for them in people's portfolio. I would not be surprised if there are other inverses that we are involved in that at some point may show up in front of this group.
Yeah, it's awesome. Lion, do you want Nico to ask question first before you take, or you want go ahead?
Nico?
Yeah, Jay. Jay, I was just curious on what's your favorite fund, and if you own all of.
Yeah, I'll do those. So yes, I own every single one of these. I make sure I always do. I'm a big believer in eating my own cooking. I use them. I own them all in a model that we manage for our individual investors, right? So we do have to realize this, right? So I've got these ETFs, but I also have this advisory business. And so when a client comes to me and says, "Wow, I want some of those, those high yield strategies you guys have," if it's appropriate for them, I'll move them into one of our models. And our models, at some point have a holding in every one of the funds. So yes, my company holds, and me personally, because I own my company, holds and owns every one of these funds. The first question, what was your first question? I elaborated too long on the second question. What was the first question?
Your favorite
Oh, my
fund.
favorite. Okay. So it depends what it is you're trying to do with them, right? So there is, we talked about the inverses that I like that as a tool, they're used to lower volatility. We didn't talk about SPY-T and QT. From a growth perspective, those are really great, right? Because you're getting full upside exposure to the index with a target 20 distribution, right? So if you want growth, and those are great. If it's just about the pure yield and income, look, it's you tell me which one of the single stock ETFs are going to go up. I like that one best that week. It's almost like asking a carpenter which tool he likes best. When I want to cut wood, a saw is best. The screwdriver is not so good for that, right? So again, it's about the use. So look, I'm dodging the question a little bit, but I am being truthful. There is a specific use for these funds and what you're doing, right? If you like crypto, I love Ybit, Misty, and Coney, right? I like those for that. If I don't like crypto, then that's not the right answer for you, right? That's the way to think about it. But I would say the SPY-T and the QT have yet to be appreciated. I think long term, from a growth perspective, because they're not fully focused on distribution and income, they're more about growth with a healthy distribution of 20%. Those, I think, have a very interesting part in any growth portfolio. And then, I love, some people don't like all the risk of individual stocks. Then YieldMax is great because you have lower volatility because it's diversified. Like, I'm really not copping out on the answer, but I can't put my finger on which one my favorite one is because there's a use for all of them depending on the circumstance.
Thanks, Jake.
All right, but Crash is my favorite name. If you were to ask me that, I can give you that. Crash is my favorite name.
All right, go ahead, Lions. I'm turning back to you.
Yeah, awesome. I have a quick question about the new products that may be in the pipeline or the whiteboard. Are you looking to introduce a exchange traded product, something around Ethereum?
Yeah, we filed for Ethereum. Yes.
Awesome. So that's it's already filed 75 days audit period, or this is?
We have not. No, it hasn't been 75 days yet, but we have filed it. I don't remember the date that we filed it. I could look it up, but we have filed for, I think it's OTHE. Let me take a look. I think that's the ticker. Yep, we have an Ethereum product in the works. Ethereum's a little harder because there's, not a lot of. Actually, I'm taking a look at my email now. Looks like we filed. Trying to see here. I mean, it looks like it might have been this month. So it's still, we have a long way to go before it's effective. The effective is the 75-day period, meaning we could now trade it. So we definitely have some time to go on that one. I think it was earlier in September we filed it. But Ethereum is tough because there's not a lot of options out there, right? So, Ybit, which is based on BITO, has a fairly healthy options market. The Ethereum market will be a little harder. There'll be less liquidity. So what does that mean to everybody here? When I say less liquidity, it means it gets harder to fill those trades. Remember, I told you trade fills is really important when it comes to executing the strategy. It will be harder to get that done. We'll have to have some partners and counterparties on the other side of those trades that are willing to take some risk alongside with us.
Gotcha. The second question I have, if you look at the screen, we have the groups here. So I understand there's a logic how you spread them out. I was kind of looking into the selection here. And something kind of I'm looking at is that I see crypto type of asset class on each and every group except on group B. Like, for example, Ybit, if it were in group B, you got kind of like overall weekly coverage of crypto type of assets around all the groups. But Ybit is group A. So group B actually lacking any, crypto coverage. Is there any consideration maybe at certain point to introduce crypto in group B so that gives selection for community to decide if they want to get exposure to crypto every week? They would be able to compensate that getting distribution on week B, group B?
Yeah, I mean, so you're correct in your assessment. We really have three focused cryptos: Ybit, which is in Group A, Coney in Group C, and Misty in Group D. You could make the argument that some of the chip makers, or like AMD, might have a crypto component to it. Not really NVIDIA though. Look, maybe that's where the Ethereum one lands, right? To spread it out. So, I think you could make an argument too, like PayPal could have been over there in Group B, right? We thought about that, and SQY could have been over in Group B as well, but we did not. But like I said, this was a little bit. There's a lot of ways to break these things up. but I would not worry about crypto exposure. There's stuff on the way in
Gotcha.
addition to Ethereum. Yeah.
Super. That's good. Thank you. I have a question about the preliminary filing that was done on the Dorsey Wright Hybrid 5 Income ETF. I was reading the prospectus. This is one preliminary, and some of the things that I'm looking at is the thought process around the indexing of the passive management that created for Dorsey Wright. There's a 40-60 split between 40% of the 5 highest ranked security versus 60% of the 5 current YieldMax ETFs. What is the thought process to choose the one for the 5 highest ranked security for the 40% portion of the index?
Dorsey Wright will pick, they'll pick the 5 top ones to use in that scenario, right? And it'll be from our list, right? It'll be from our list of single stocks. The 60-40 mix is meant to be kind of an offset of not having a full YieldMax exposure, right? So imagine you're 40% long, Tesla. I'm just going to go off the top of the groups, right? You got Tesla, NVIDIA, Coney, Misty, and Google. Let's just say those are the 5 tickers that you have. If 40% of it is just long stock, you're going to have more upside participation. And then the 60% will, generate the distributions, generate the yield, and still have the same exposure to those same 5 tickers. But, you could be capped, right? But you're getting the distribution. So it's meant to be like there's some folks that believe, hey, we should have a fund that's 50-50 or some long stock with some YieldMax of the same stock. My feeling has always been people could just do that if that's what they want. But with Dorsey Wright, I agree there's an added bonus here because you now have kind of this technical analysis that's trying to pick winners. So I don't mind it in this scenario because the fund is driven around growth and technical kind of the ones that technically look like they'll grow faster. So in this scenario, it makes sense to have a long stock only allocation piece and then 60% so you still get some of the distribution. So hopefully that explains that strategy. Again, that was filed Friday, so feel free to, it sounds like you've got time if you're reading prospectuses. I always love to talk about it, but not everybody does. But think about that as more growth with income as opposed to straight up income.
And any idea what is going to be the yield that's coming from the 60% of the income of that?
Yeah, it depends on the underlying tickers, right? Like if the best tickers are JP Morgan, XOMO, Dizzo, and what's another low one? Google and Apple, then it's going to be low. If the best performers are going to be, some of the high flyers like NVIDIA or Coney Misty, then it'll be higher. It all depends on the holdings.
Gotcha.
It's going to vary, absolutely, for sure.
And it's going to be reconstituted at the index every month, right? So every month you're going to have like a committee looking what's going to be the reconstitution, and then, right? That's the way I understand it.
I mean, that Dorsey Wright will create the index that we will follow, right? So it's, that's the contribution they'll make to the fund.
Gotcha. Thanks for that. I appreciate it.
So Jay, when I talk about this other fund managers hang out in our Discord too, they help us. They help us by just answering a lot of questions on just how fund works, how ETF work, how stock work, or how the market works, just basic economics. Peter is one of them. Peter, go ahead and unmute your mic and go ahead. Peter, you there? Yeah.
I am. Thank you. Sorry, late to the party this evening, and thank you, Jay, for coming here and talking with the community. Really appreciate it.
You got it, Peter. Nice to meet you.
So my question is, do your traders manually work your orders and strategies, or are all your trades fed into an algo and executed when your conditions or rules are met?
It's a little bit of both. So the first thing is, deciding the entry and exit prices ahead of time based off of what's going on in the options market, whether it's the implied volatility or if there's some sort of an earnings event, all the things that kind of drive us to select our strikes, will then you're right, that kind of kicks out from our rules, right? Okay, here's where we should be looking to meet our dividend target, right? Once we've determined that and the size of the trade, which is another piece of the pie, we then will do what's known as an RFQ. So if you're familiar with that process when it comes to trading, we'll ping all the big liquidity providers, whether it's Main Street, Citadel, Susquehanna, Old Mission, a few others, and we'll get the pricing based on the limit that we think that trade is worth. We'll put it out there. They'll actively come back, and then we'll send the trade to the destination that gave us the best price. There are times we'll break it up across a few as well, because they all want access to our liquidity. So that's the process that we go through when it comes to filling those trades. So it's a little bit of both. Where we never let option trades get sent into the market with an algo. Even if it's 100 contracts, I wouldn't do that, right? We still want to make sure we're getting the right price, and you're not dinging a small batch of contracts or on sitting on the bid or sitting on the ask, right? We'll always make sure that we define what those trades need to look like before we send it out, and then we'll RFQ it.
Much appreciated. For those that don't work in industry, RFQ is a request for quote.
Thank you. Yes, a request for quote. A little jargony term that I use. Sorry. So it's, we'll put it at here's an example, right? We want to sell an option. We think we should be getting $1. We'll put it out to each one of those, liquidity providers, or even go through one of our brokers, and we'll say, all right, everybody come back with a price. If nobody comes back with $1, we don't send it out. But if one comes back with $1, another one comes back with 105, another one comes back with 106, send the order to the person that's going to pay us 106 for that.
Yeah, one of the discussion we had with Peter, and there's other funds managers too, and a lot of time they send some of the company, they send some of the younger newer investor come hang out with us, and well, obviously we don't need to know their name of the company and stuff like that. And some of them they share with me, but I don't share with everybody else, and so I know who they are. And but it's awesome. Like Peter is a good example. On his spare time, just think about, he's going to go to work and do this thing, and then but on his spare time he'll spend a few hours with us and talk to us and answer questions and just essentially just teach us how to be a better investor overall. So I think all these guys, it's just unbelievable, because you're all contributing. Like what I start off with my first monologue, that these funds change lives and save lives because you're affecting the income at the root level, at the grassroots level, So yeah, thank you, Peter. And I didn't understand anything you said with Jay.
Sorry.
Yeah.
But you got me. So Peter, just as an FYI, right? Like, which is almost a follow-up question, which I would assume you'd ask. We're probably trading over 1 million contracts a week at this point across our funds, right? So we're moving some heavy dollars on a pretty active basis. You have to look for best execution, and options are much harder to do that than say stocks, right? Because the market, the liquidity is just different. So yeah, it's really important that we have a lot of rigor around the trade execution.
And when you're trying to go for an RFQ, are you trying to ping around the theoretical price for the option contracts and kind of working the order from there?
Absolutely, right. We know exactly what, like our synthetics, right? Really good example. We know mathematically exactly what the synthetic should fill at, because it's just a cost to carry trade. So again, sorry, that's jargony, but basically it's interest rate times the value of your position, right? That's a trade. We know exactly what we should pay, right? Or get paid for it. So for sure, that's an easy limit. Then when it starts to come to like the short calls, you have both your theoretical, which, simple Black-Scholes, we don't need to get too complicated. Simple Black-Scholes kicks us out. Here's where you should be. But then you also have to look at the liquidity and see what's even viable. Like, if the market's skewed versus what it really should be worth, you'll see that in the IV. But yes, absolutely. We know what we want to get before we send a trade.
Peter, I have a question for you. Now, Jay is very popular among our community because we watch all his video, especially us, because we watch literally every video. No matter where you at, we'll watch it. Now, how popular is Jay in the world of investing? Like, do you guys have a poster of him somewhere, like in the office?
I don't know. Sounds like Jay's a superstar here, so I
If
wouldn't
he
be
had one,
surprised
he'd
if everyone
probably
had a
throw darts
poster.
at it. Yeah. Very fun. Thank you, Peter, for that.
Thank you, Peter.
Jay, send me your address. I'll send you a signed, headshot for you. Kidding, but I will send you a signed book if you want one.
There you go, Peter.
Maybe get you in a trading floor. We'll talk salary after.
You got it. If you're on Bloomberg, ping me.
All right. So, Jay, remember I talked about at the beginning, there's a lot of community hangout in our community because, when they're starting out, they're not that big in terms of YouTube, or they're just brand new. But we got, like I said, we got multiple community within the community. And I want to introduce you to KC. He's our hot dog salesman. We always talk about that because he essentially make money selling hot dogs, and now he's doing option trading. I mean, the advanced level, after 2 years of this stuff, you get really good at it if you read the book, study, watch it all the time, and constantly watch your trade. I want to give him a chance to talk. And this is from KC and his community. It has a big following also in his channel. KC, are you there?
Yeah. Can you hear me okay?
Yeah. You get a chance to talk to Jay, brother.
Hey, that's exciting. Jay, first, my name is Mike. Thanks for coming on the community. It means a lot to everybody, honestly. So thanks for that.
Mike. Nice to meet you. I thought when he was going to say you're a hot dog salesman, like you were selling the channel to people, but literally you're selling hot dogs. That's awesome. What kind of hot dogs?
I own a food company. So, hot dogs is just one of the 100 items we sell. But, yeah.
Oh, that's awesome. Okay, good. All right, what can I do for you?
Okay, so I have two questions. First one is, what is your personal favorite option trading strategy from a personal level? I know it depends upon market conditions, stocks, etc. But if you could pick out your personal favorite strategy to trade for your own account, what is it?
I really do like kind of long exposure using options, whether it's long calls or synthetic long. I think on the long run, right? I don't mind a little time decay using a deep in the money call to get upside exposure. It's actually a strategy we use in that Z hedge strategy. But over the long run, markets generally go up, so I want to be a buyer. Yes, we have down markets like 2022 or 2020 or even the latter half of 2018. But it limits your risk. It's a naturally hedged position, right? So you can only lose what you pay for a long call. I like using in the money calls that have lower time value in them and go out a longer period of time. I think that's a great way to invest over the long run. So that personally, over long-term investing, that's a great one. And I wish more people knew about it because it's just naturally protected position and you've got upside capture and the market generally goes up. Like it's like this little secret of our industry here, guys. And I'm sorry, I'm going to rant for 2 seconds. Those new investors out there, like when people ask what should I do if they came across $10,000, my answer is buy the S&P, buy the Qs. Like not until you get, large, 6 figures do you need to have like professional management. You could do it, anything under $1 million, buy the Qs, buy the SPY. Generally those go up. And it's like, and it costs you almost nothing. Like I love YieldMax, don't get me wrong, and I love the distribution characteristics of it, but if someone just came to me and said, what should I do with money? I tell them, it's depending on their age, either buy the Qs or buy the S&P. So when I say I like to buy calls on the index of the markets, that's why. Just generally markets go up and I want to have a piece of that. I've heard people tell me investing, the markets are like gambling, like a casino. Yeah, it's like a casino where you win 70% of the time. Why would I not want to have exposure to that as much as I can? So anyway, a little bit of a rant there, giving you a little of the advice that I give to any starter. Just owning the market is going to treat you well over the long run. So long calls, long data calls.
I'm sorry, I didn't mean to cut you off. So you're talking leaps on SPY, for instance, just generally. Okay.
Yep, you got it.
And then, sorry, Discord always has some kind of little hitch and a giddy up there. Okay, second question. I know you use mathematics for your option trades, IVs, etc. Does technical analysis ever come into play when you guys are placing a trade?
So it does, but not from our decision point. So it is absolutely obvious in the option pricing where the technicals tell you the market is going to go. Like you could see, like let's say there's a stock and it's got a resistance level at 200. You will see the time premium so much lower in the 205 or 210 calls because the options market itself is applying technical analysis. So you can absolutely see it in the price of the stock. Price of the options of the underlying stock. So we are absolutely aware of that. Look, there's some times where we have to make a discretionary call between am I selling the 205 or am I selling the 210 strike? Yeah, if I look at a chart, I look at a chart. I'm not impervious to that. I want all the information I can to make the best call. However, I'm not going to make a bull or bear call outside of the parameters of the strategy. So with YieldMax, our goal first and foremost is yield. Second is upside capture. It's not part of our methodology for the single stocks, but it's something we observe. Ulti, however, absolutely we use technicals, right? We will look at indicators like MACD, RSI, stochastics. We'll even look at patterns like head and shoulders and pennants. So we will apply every tool we can to Ulti. When it comes to the single stock tickers, it's already baked into the option price, but we still look.
So, okay, I lied. I have a third question then since you got
Don't
the
worry,
thought bubble.
bro. Don't worry.
Okay, so if you're running technicals on Alti with all the different underlyings, how are you choosing which underlying that you're doing the technicals on? The one you have the most calls on, or what?
Yeah, so technicals are part of the decision process, and it's not the biggest, but it's definitely one. The first and foremost is what's the implied volatility of the underlying stock, right? Can I hit this high IV? The second piece is, can the market handle my volume, right? Right now, we're putting on about $10 million into each one of the positions in Ulti, 9 or 10 million. Can the market even sustain that? Like if there's a $10 stock, I'm about to buy a lot of shares when I put $10 million into it, right? Buying 1 million shares. If the average daily volume is only 5 million, I'm going to have a problem getting in. I'm going to have a problem getting out. So then we'll look at volume. We'll also look at the option volume as well. That's important. Then we look at the technicals, like we just said. We'll look at some very basic technical. We want the stocks to go up in Ulti, right? So I want bullish technicals. I want it above the 200-day moving average if I can, or has it made a very discrete and volume supported bottom? We'll look at RSI. Is it oversold or overbought? We'll look at those kind of data points. And then, by the way, the last thing that we look, and someone asked me an AI question earlier, and I will add one little piece here. We will actually look, is there any news or like huge pending lawsuits or acquisition news that we may not be aware of? Because we move quickly in Ulti, there's not enough time to research. Usually our screener kicks out 300 stocks. You can't screen 300 stocks, in the morning before you go trade, right? To know all the ins and outs of the stock. Certainly I could look at a chart and we those data points are easy, but to understand if there's anything outstanding. So we'll actually use AI to search for any large pending litigation or any pending acquisition activity on those stocks. So I shouldn't say made fun. I said, everybody's used AI in the past. We use Ulti AI to kind of look for kind of data points that are out there that, might be news driven that we might not be able to find with, looking in Bloomberg history or, the news on Yahoo. So hopefully that gives you a perspective. By the way, I forgot to even mention, we'll also look to make sure we're not concentrated, right? I don't want 40% of my fund in crypto or chips, right? Or biotech. So we'll also diversify. So all those data points go into Ulti. It's why I said Ulti really is like a hedge fund, right? There's so much that goes into it. So
that is your baby, man. You really went into it with Ulti. That is your baby right there.
Yeah. It's a tough one. It's hard. And when we get the new, and I would say if there's one fund I really, really wish was pulling its weight better, it's Ulti. I'm really waiting for the additional option tactics to come in. The biggest problem with Ulti has been, we got 20 tickers in that. Let's say we got 20 tickers in the portfolio. If one of them has a minus 30% day, which happens when you're looking for high vol stocks, it hurts the whole fund, and it's one ticker, right? So having like unlimited, not unlimited, but going back to risk, the inability to limit my risk in Ulti has been a little bit of a personal problem. When we have the ability to do more tactics in about a month, I think Ulti will really have a nice resurgence.
All right, that's it for me. Jay, thanks, man, really, for coming on. And you have given my family years. We're going to retire with JEP-Q or JEP-I. With your funds, you have speeded my retirement by at least 3 years. And so
happy to hear it. Glad to help, and thank you for the support. Thanks for using the funds.
I really appreciate it.
Yeah,
Thank
Jay,
you, Khmer.
if you ever stop by the area, his area, you got to go get some hot dogs, some good old American hot dogs.
Yeah, where are you?
I'm in Kansas City. We got 20 locations, so
all right,
we're a little busy.
I'm in KC all the time.
You know,
win tonight, but
one thing I like, he was making YouTube video where he was making hot dogs, and he had a live stream. And it was funny as heck watching him selling hot dogs and talking about investment. So it's a lot of fun watching his.
You do any Chicago style? Like Chicago style is my favorite hot dog, even though I'm a Jersey guy.
Actually, we own a concession company, so we are at like major youth. If you're familiar with Kansas City, we're in Lee Summit at Legacy Park. It's a major sports complex. We have all those contracts. We have all the major high schools, Blue Springs, Lee Summit, Independence, etc. So that's where we play our trade, and it's just hot dogs with a packet of ketchup or mustard. It's we own a concession company. So
gotcha.
That's that.
It's awesome.
Appreciate you. Thank you. As soon as I figure out how to mute myself on this phone versus a computer.
No worry, Casey. Yeah, Jay. So how do you like this format where you don't have to wear a suit and tie? You could just be in your underwear or no, in your pajamas and walking around the house with a headset on.
Well, first, you probably haven't seen me have a suit and tie on many of the videos in the first place, but look, this is fine. This open discussion is great.
Yeah.
I didn't know if there was going to be video or not, so I am in a button down, but I do have shorts on.
Yeah. So one of in this community we have the club, and this is one of the questions that people ask. They just want to know what if you were to be in this club. We have the 1,000 monthly income club, 2,000 monthly income club, go all the way to 200,000. We just stop there. Otherwise, our Discord, which is full of numbers. And so anything over 200,000. So the question people ask you is, if you were to be in this club, what club, monthly club you would be in? I kind of can guess the answer, but anyways, the question. So I want to throw it out there.
From my YieldMax investments, right? Because remember, like, my business is leveraged to YieldMax, right?
Yeah.
Right. So the income for Zega is highly tied to the ETF revenue.
Yeah.
Like, look, I'm thinking about my portfolio. Here, I'm writing it down right now. Do my math real quick. Yeah, I'm probably in the 20K club for my YieldMax investing.
That's
probably
awesome.
That range.
Yeah.
Yeah.
There you go. We're pretty close to you. I'm close.
It's not my only investment. I invest in all of our strategies at Zega, right? So for my ETF portfolio, it's about there.
Have you heard people talk like that? Because we only talk like that. Like what are you the 10,000, 20,000 club? Because that's how we measure our income, our portfolio.
I really nope. You guys are unique. This is definitely, like I said, a unique group that has a very. It seems like a singular focus on the distributions, which is great, which is why these exist. But to even categorize yourself that way is interesting. I usually find people in the, style of investing, right? Like whether they love Coney, Misty, and Biddy, or they're more along the lines of, they just want the extra little kicker on top of an existing position they have. Like. Apple's the most widely held stock. We have a lot of people that own Apple, but then put 20% in Apply because now they want to have a bigger dividend, right? Like there's a lot of folks that just do that and they categorize themselves that way.
Wow, that's awesome.
You guys are unique.
Yeah, Peter just came back and he wants to know if you can ask one more question. Yeah, so of course, Peter, you're part of the family here. So
thank you, Bon. Yeah, because you're using flex options, Jay. Does it does it make a difference what option pricing model you're using? So Black-Scholes versus binomial, or even the trinomial model, or even maybe like the Berkshire-Strandland model. Does it make a difference?
All right, so that's a nice detailed question. The answer is because we use the flex options, we use them Euro style, so it does change the model a little bit when you're doing a European versus American style. By the way, for those of you that want to know, European style has nothing to do with Europe. It just means that you can't get assigned early. You can only get assigned on the day of expiration. The reason we do that is in our synthetics, we don't want to get assigned early on the short put, right? We don't want to end up taking stock on a Wednesday when our options are expiring on a Friday. So, so the model changes for sure when you're selling puts or buying calls in a Euro style, but it also moves to your advantage on the inverses where you're selling calls Euro style and buying puts. So it's more of an interest rate model when it comes to the flex options. Like I said, it's more of a cost to carry calculation. The only fund where we use flexes for the short call, the weekly covered call income, is YBIT. The reason we do that is because BITO has this ridiculous dividend that didn't exist when we did, the testing of that model, and we don't want to get assigned early on those, and so we use Euro style just on the short call at the end of the month. All the other short calls we sell are standard exchange traded, and we'll just use Black-Scholes. But for the synthetics, it's more of a cost to carry, which almost always that's the short put. And at Defiance, we started using a 1 day for JEPY, a 1 day flex, only because we wanted to be able to select our strike price. It's a 1 day trade. The models don't do so well on a 1 day trade anyway. It's just what the IV is there. So yeah, so I would tell you that it is more of we use flexes for protection, right? So you don't get assigned early. And then we use, it's more of a cost to carry calculation when it comes to that, which is more interest rate based. Short calls are not flex, with the exception of YBIT once a month. Hope that helps.
Yeah, good to know. I guess if it's you're looking at cost of carry, and the interest rates, I guess the Greek row would come into play in these models for you.
Absolutely. It's all row. Nobody talked about row for a decade and a half, and now that's all everybody cares about.
Thank you, Jay.
Yeah, Jay, this has been an amazing night. We really appreciate it. I was to be honest, I was a little nervous because I didn't want to attract any more attention. I literally want to do this just to help a small segment of group of people, and then our YouTube just got bigger and bigger, and the community just got to keep getting bigger, and it's not slowing down at all. We are one of the fastest growing community, and it's just not slowing, and so I was like a little uncomfortable. I was a little nervous, like, man, what's going on? Like, and plus I'm not in your field, so I don't even know how to ask the questions. Like, what happened if a topic come out and I don't know what they're talking about? Literally 90% of the stuff you talk about, I didn't know what you're talking about at all. But
you know now.
Well, we're gonna have a lot of follow-on questions. I took a lot of notes, and it's just been a lot of fun, Jay. One thing I told everybody, if I have a choice, I'd rather have him hang out and drink beer with us anytime. So this way, I want you to be a friend of the community and just come in and out anytime. So now you have our Discord link, and all you do is click on that button. You can pop right in, and you can see that this conversation go on because you brought up so many open questions for us, and there's a lot of new investors. You can see that we're going to be talking for the next 2-3 months all these things that you bring up. So it's gonna be amazing. Just discussions, great learning, and new people come in all the time. They always ask questions, and thank you for showing up here.
You got it, and like I'm happy to come back with as you shoot me notes if there's any real pending brain teasers that you have about the funds. But let's queue up some more questions and schedule some time for me to pop back on and in the future.
Yeah.
I'd like to extend my gratitude also, as Khmer mentioned. also for the communications and everything that you shared with us. And yeah, if you have any question you want to ask us, you can jump in, or you can send me also emails the way.
Yeah,
that
I
you
might,
did.
I might use you guys as like a micro marketing or market research channel from time to time, and hit you up with just thoughts and questions around some fun characteristics.
Yeah.
You never know. That
Awesome.
might be a nice two-way conversation.
Yeah.
There you go. Yeah, awesome.
Do you like this group? When I was talking to Lions, I told him, I said, I don't know if Jay liked this format because that's how we do it. And
I gave you 3 hours. I obviously don't like it.
No,
I gave you a lot of details, right, Jay? You wrote to me. Thank you for all the details that you're providing about the forum and how we run our, calls here.
Yeah.
Got it.
Wow. So
right.
I'll let you. We have this tradition where when the show is closing, and I just always let the last speaker is usually somebody who's new and stuff like that to close out the show. So I give you the honor to do this, and yeah, I know I really appreciate it. Do you want some more questions, or a couple more questions, and then call it, or you wanna? All right.
No, I'm good calling it a night. I think we've gone through a lot of great topics today, and so again, I would thank Lion and Khmer. Thank you guys both for extending the invite and following up and helping. I know it was a little last minute for me coming on, just we really didn't even decide till Thursday or Friday. So appreciate and everybody for attending. A lot of you have stayed a long time. Like, wow, that speaks volumes to your commitment to your community. So really impressive group here. Like it. Love the diversity of everything, investment knowledge and geographic, and all this is really great to get exposure to. Look, I will. I've seen in some of the comments that I'm reading on the side here. So thank you everybody for the kind words. Appreciate all that. I will tell you that just know what you're investing in, and continue to make sure sorry to go back to it. Just know your risk, and I know that the income is always really attractive. Make sure you understand the upside downside characteristics. That's it. So I'm just kind of not only covering my butt, it's just good advice, right? I never want somebody to be like, I didn't understand XYZ could happen.
Yeah.
I feel like I've covered it a lot here. It sounds like you guys do a good job of explaining it as well. So look, I want to continue to be an innovator in this space. I think the world should adopt more options. You guys are a chance for us to get that message out. So this is a great back and forth. Appreciate the opportunity today, and hope everybody get ready for Mark on Monday. Here, another week. Should be interesting, right? We got a Fed week this week.
Yes.
Watch out.
Fed week.
Well, thank you so much, Jay. And I don't know if you know how to leave Discord. So there's a couple ways. You have to close out your app and your desktop. So you have to right-click the app. There's a little icon and Discord, and that's how you close out. And but otherwise you're still in it, And
got it.
Yeah.
Try to figure it out.
Yeah. or you just right-click. I think it's disconnect. Yeah. You just. But no, I really appreciate it. Thank you so much for being here, and I think we're gonna have 1,000 more questions. One thing I was hoping you get to meet is some of the new investor. When you hear their story, one thing I wanna when I was prepping this, I was saying, hey, the reason why our community is amazing is because your stories. That's why it's amazing. I think Jay want to hear your story. Like Bill, he's talking about his truck driving, and I could tell he's nervous, and a lot of people are nervous about Emily. I want her to share your story. There's a whole bunch of people with some really, really tough story, and they're looking at these funds, and like I said before, Jay, your fund not only changed the world of investment, but you gave every single person who's been making $30,000 or less an opportunity to get out of the situation they're in, because there's no way to get out, and they realize that unless they do something about it, it's not going to change. Their life's not going to change. So now they're doing something about it, and so you are changing a lot of lives, and you're essentially saving a lot of lives. So thank you so much.
Nope. Thank you guys. Glad to hear it. Love that positive feedback. Thanks so much.
All right. Take care.
All right, till next time, everybody. Thanks so much.
Bye.
Thank you. Have a good night.
Thank you, Jay.
Bye bye.
All right, hey, that was awesome. First of all, I did not hit record because we were getting the technical issue. So when I go back and upload this video for all of you, you're gonna see that I lost at least a good 10 minutes of the conversation. So the introduction, the monologue, my monologue, Lion's monologue, and then Jay introduction. So you'll miss that, but that's okay. At least I got the rest of it. So I only have 2 hours and something minutes of video, but he's with us for 3 hours. So I just want to say, hey, thank you so much, and thank you all, especially the new people who like never been to our community before. You guys are true professional. This is one thing I want to meet this side of you, but for some reason in the last 6-7 months, I always thought that, you know, the finance community, I literally thought the finance community was even worse than the gaming community. The gaming community is really toxic, especially Call of Duty game and League of Legends. There's a lot of toxic community. And I always thought the finance community would be more professionals, but it turned out to be it's not so. I get crushed all the time by haters and stuff like that. But this is the first time that I'm actually in love like with overall everybody. I always love our community, but then this is open invite to everybody, and it's the first time that I was a little nervous, and you know the open community embrace, and they, you know, they were very professional about it. So I want to say, hey, thank you so much for being professional, because and you know, whether you like his fun or disagreed or agreed, whatever, you should always be a professional all the time, because you know it's a reflection on you, your character, your personality, and you just always want to be a good human being. And no matter where you at, you want to be a good human being, and you did great. With that, Lions, I wanna let you have the last words before I shut down the live stream.
Yeah, I'd like to thank everyone, first of all, for all the questions that you guys brought up. They are very good questions. And Jay has been able to get all the insights, and you get a lot of good feedback and very good questions. We're going to talk a lot. We're going to talk about it a lot and in the next days and weeks ahead of us. And hopefully we can see Jay coming back to us and kind of jumping in, chilling out, talking to us, having beers as Khmer say. So we all enjoy that. So have a great night, everyone. Thank you so much.
All right. As I play my music to shut down here, I want to say thank you. And
thanks.
all right, if you're on Twitter, thank you so much. I'm shutting down Twitter right now, so it's good to see all of you. Thank you for watching. I appreciate it. I multicast, so if you watch on Facebook or on some other platform, thank you so much for watching and enjoying. Take care, everyone. Bye-bye, Twitter. All right, YouTube. Hey, thank you all so much. Thank you to all the moderator for moderating. You know, our channel is very, very busy. We're always this busy, for those who don't know that. And we have a lot of moderator. The only thing we ask is just be professional all the time. You should never ever put yourself in a situation you get banned in any room. You know, so it doesn't matter what room you go to, it doesn't matter what channel you go to, it doesn't matter what community you go to, it doesn't matter if we're playing video game, we're playing chess, or we're talking about stocks. You as a human being, you should never put yourself in a situation where you get banned from that community. And if that's the case, I hope that's a reflection and you learn from that and just move on. Don't take it personal. It's just that, you know, you and I, or you and us, which is not aligned, and eventually we don't have a lot of community. The high space, high yield dividend is not a big community. So once you got banned from like 4 or 5 of us, then you're pretty much out of the loop from everybody. So it's just not cool. And so with that, I want to say, hey, thank you so much, and make sure you wear seatbelt, drink milk, don't run with scissor, always love your mom, and there's a few things you should be afraid of. God, and you should I was gonna make everybody know my joke, but anyway, thank you so much. Peace out, everyone.